of a tech company, right? No, I mean, that's like the function. And the number one functions that a lot of leaders want to get rid of is sales and marketing. Because it's like, I don't know what those guys do. You know, they have conversations. Oh, they went to a client dinner. Like, let's just not do that stuff anymore. And I think it can be fine to keep existing business or even grow it a little bit if you have none of these creative, design, like any of these functions. But you can't grow a company without, like, there's a reason why that holistic stack of what you usually have as a large employer, like, there's a reason why it exists. And I do feel like, you know, we will see a lot more job cuts. And eventually, one company is going to come out and be like, I don't know, I don't think that really worked out for us, having 0 salespeople anymore, or having the whole sales funnel go through like 3 people instead of 40 or whatever it was. I do feel like it will go too far. But the environment right now is going to give you that overhead to cut too far and then undo it in 3 or 4 years.
Yeah, we'll see how it plays out. All right, well, that does it for Miles and I. Futures are still down, although not down quite as much as they were earlier. We continue to watch oil prices. Metals, not just gold, are rolling over big time today. Aluminum is down quite a bit. So.
We ran out of time to do your bracket, too. Devastating to me.
Sure. If you ask me who's going to win it all, Miles, I don't know. Okay,
I don't really care either.
Opening bid is next.
I care more than you.
With Brian Sozzi. True.
So we needed a unified solution. We knew that a system like NetSuite will help us scale. Having put NetSuite in place, we've definitely optimized our processes. So employee productivity has shot up significantly. In terms of inventory level accuracy, we are over 95%. Our order to cash cycles are very smooth. I would say it's double-digit improvements. The future within NetSuite is to bring in all the other subsidiaries and entities within NetSuite as well. So we want to have the entire operations all centralized within one roof.
Go back 400 years in a single afternoon. All the
What's interesting about it is that the most technologically advanced firms are actually reducing their headcount faster than anyone else, which is a pretty interesting tell. For many organizations, I think they will find that they certainly don't need to hire people, or they need to hire much more selectively, and there are areas where they don't need people. And they can accomplish the same objectives and maybe 10 times more with less people as well.
The thing that I think a good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector.
As the shockwaves of Operation Epic Fury continue to ripple through the global economy, we are witnessing a dual transformation of the American landscape. On the one hand, the cost of living is on the climb as higher oil prices filter through the financial statements of very large companies. Then there is the generative AI revolution as it shifts from a boardroom curiosity to a structural disruptor. The question is no longer if the job market will change, but how many millions will be caught in the transition. Here with me now is IBM Vice Chairman Gary Cohn. Gary is the former director of the National Economic Council during President Trump's first term. Gary, good to see you.
Great.
I love that you always come prepared. You got the dot plot here. I mean, that's why I love having you on.
You know, it's very nice geometric shapes.
No, it's great.
So I thought I'd bring it in.
No, it's awesome.
In case you know, we want to talk about the geometry.
I also love talking to you because you talk in, you make a lot of sense to me every single time. So we heard from Chair Powell yesterday. He didn't want to commit to how higher gas prices are going to impact the economy. For the average human out there, is what we're seeing with oil prices transmitting to gas prices, is it recessionary?
It's absolutely recessionary in the short term. Like, there's nothing more instantaneous to a consumer than standing there holding down the gas nozzle and watching the numbers tick on the pump. You know, every consumer in this country knows exactly what they paid the last time they filled up their tank, what they paid a month ago. And if they were paying $80 a week ago and they're paying $85 this week and they were paying $60 a month ago, they know that I lost $20 of disposable income in filling up this tank of gas. And unlike people that live in New York City, the hardworking Americans in this country, they drive a lot of miles. They can fill up their tank 2 or 3 or 4 times a week. If you're filling up 4 times a week, that's $80 of disposable income coming out of your pocket, after-tax disposable income. That's the difference between taking your family out to dinner and not taking your family out to dinner a couple times in a week.
When does this start showing up in economic data?
I think we're starting to see it come through. Remember, we're sort of week 3, going in maybe week 4. It takes some time for the transmission mechanism to work its way through the system. The other thing that you need to understand, and you do, we in the United States, we're actually in a pretty good position. We don't have a supply issue. We have all the supply we need. In fact, we're exporting natural gas, we're exporting oil right now. The rest of the world actually has a price and a supply issue. So we know we've got the oil here, we know we've got the natural gas here. If you're in Asia or you're in Europe and you're running a government there, you're making really strategic decisions how you're going to use the oil and gas that you have. And in fact, parts of Asia right now are shutting down businesses, closing down schools, asking people to work from home, and doing all the things you would normally do to start saving and economizing on the amount of oil you consume.
I'm going to get this question, so I'm going to put it to you before I get out there on X. Are we in a recession, or we are
like a bubble test, like you would take in high school?
Okay, I was thinking like a blue folio.
Or like filling in bubbles where they're just like, okay, I don't know, this one. They're like,
the SAT for central bankers.
Right. I mean, like, obviously the stakes are high, but it's a very unscientific, and these guys are smart and they have lots of research, blah, 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 but, you know, it's not very scientific. The other interesting thing, somebody asked him, you talked about at one point getting rid of the SCP.
Yeah.
Whatever happened to that? And he was like, nobody else wanted to do it. I was the only one. It was kind of how he said it. There wasn't broad support on the committee to do it. So But that also was a reminder to me, by the way, when he said there wasn't broad support, even though he wanted to do it, there wasn't broad support on the committee. That was a good reminder to me about even when Warsh comes in, and everybody says, well, this is a bigger committee. That's a reminder that, like, the chairman doesn't get everything he wants. So, and of course, the other big news item out of it was that he's going to be the chairman, or the temporary chairman at least.
That's right.
For a while until the investigation is concluded and Warsh eventually gets in there.
Yeah. All right. So one other thing, well, two other things from the press conference. No mention of private credit, which I guess sort of ties in the last point. I don't know if we need to dwell on that one.
Yeah.
AI and how it plays into the economic backdrop that the Fed is dealing with. It came up in the final question that Powell got, and I thought he had a very interesting answer about the AI contradiction that we're starting to see in the economic data, and I think there might be other pieces of that playing out in other parts of let's call it, business world. So Powell is talking about AI, and he's like, well, you would think that, intuitively, maybe there's a productivity story here. Hard to tell, and he noted that in prior cycles with huge surges in productivity, it gets revised away later. So productivity data has often been hard to come by in terms of quantifying how much return you're getting on any kind of investment from worker productivity. The other part is that right now, AI, while in theory is disinflationary, is in practice inflationary, because you have this impulse to be hoarding materials because you have a massive AI data center build out. You are seeing a surge in overall GDP. Headline GDP growth is rising as a result of this build out. And so at the same time, you have firms saying we're either cutting jobs or slowing hiring or doing no hiring, re-examining our hiring practices as a result of AI. And so I think his answer in the end is like, we'll see, which it feels like the correct answer for anything. It's very Powell of him to say. I don't hear a lot of "we'll see" from the AI advocates, however, right? Like in our day-to-day conversation, what we're kind of reading, consuming, it's like, no, this is happening. Don't worry about it. Like it's one way forward. And I think for Powell to be circumspect about it, it felt to me like the most powerful voice yet, who was willing to say, I'll take a side seat on this. I don't say back seat. He's just like, you guys can do that, and I will watch carefully.
Yeah, but as you say, it is also perfectly in keeping with Powell, right, and his character, that he is not ready to pull the trigger on things or opine on things until he feels like he has more information. And as you and I know, yes, all of those decisions are being made, but we haven't seen the outcome. Like, as we talk about frequently, like, we haven't seen the return on investment yet. We haven't seen sort of the end game of all of this yet. And so it makes sense that he would say it. I wonder if because it was the last question, because the conference was much more about inflation and oil, I wonder, hopefully we'll get more on that. I hope that they'll continue to ask him about it and sort of pay attention to his voice on that.
That's why I always liked, I usually got the last question, like the 4 times I got to ask a question. It's a nice spot to be.
It is.
Because you don't have to ask about the SEP, because it's already been asked 15 times.
Yes.
You got to come up with goofy stuff like what I asked about, the inverted yield curve one time, which is like, you never ask that question if it's top 10, because that's not
right.
That's
and
not
everybody asks some version of the same question.
Well, because that's the question that needs to be asked. There's a whole dynamic around that. All right. Speaking of AI, we did get some corporate results last night from Micron. That stock is lower, even though the results were better than expected. We see spending higher. You see supply constraints there, and it feels like this is going to be okay. First question, is this the beginning or the end of second quarter earnings? How do we think about this? How do you think about this? Is Micron wrapping it up, or are they leading us? I think they're
wrapping it up.
Okay, so Micron wraps it up. All right, so even though they're wrapping up this past reporting period, it does feel to me like maybe we're starting to see the outlines of what will be a more frequent dynamic within earnings reports, which is great numbers now, and the outlook is just starting to have folks ask questions of like, this stock's up 50% this year. Do I need to be buying more with this kind of a forecast?
Well, and it's the question of peak, right? This is the question that whether it's hyperscalers peak capex, in the case of Micron, the question is around peak gross margins. I was reading a lot of the commentary around it. So just for people who haven't followed Micron that closely, high bandwidth memory is something that they make that is now vital for AI. They've taken away capacity to make high bandwidth memory from their other memory, which has caused the memory chip shortage and caused memory chip prices to go up. All of that is good for Micron, not so great for anybody else who wants to buy memory chips, but it's good for Micron. It's good for Micron's margins, which have been like in the low 80s. And so the concern here is that as they sort of make more products, as they expand their production capacity, that those margins should start to, will have a diminished, as one analyst said, further price increases would have a diminished impact on margin expansion. So that there actually seems to be like a maybe real concern, but it echoes the concerns we've seen from a lot of these things that like, are we near peak of whatever it is?
And I think the other part of that as well is this idea of, you know, these are cyclical, these have been cyclical businesses over time. And it seems like we are now seeing more and more investors say, like, we are still a cyclical business. This, you know, memory, you know, all kinds of tech hardware have had ups and downs because it's, you know, physical supply with, you know, let's call it deployed demand. So you continue to see, like, rewriting the idea that this was just going to be a secular winner, or that any of these companies are going to be secular winners, and that maybe the cycle isn't as violent on the way down. You know, I'm not saying that these stocks are going to go down 50% like they have many times in the past. It's just that are all these names now getting secular type benefit of the doubt, the way that, you know, again, we don't need to pick on specific names here from other sectors and, you know, completely different businesses. But again, I think it's this idea of the AI cycle has been so forceful on the way up that it did feel for a long time that there was just never going to be, like, you know, exponential log scale all the way up. And it's just starting to see the outlines of, like, well, there will be a cyclicality around it. Maybe the cycle is just a margin cycle. It doesn't mean that demand for the, you know, revenues can still go up, but if we're going to have some kind of a margin cycle as a result of constraints, well, then that probably has to get into the price somehow.
Yeah, I mean, another comment that stood out to me from JP Morgan took the other side of that and said customers are treating memory less as a commodity input and more as a strategic asset. But to your point, that doesn't mean it eliminates all cyclicality from it.
Yeah.
It just means it's maybe not as violent of cycles, or they're longer cycles, for example, than they've been in the past, which is, I think, is what it's potentially going to look like.
Yeah.
So, should we move on to?
Yeah, where do you want to go?
Where do I want to go? Should we go to Rivian maybe this morning?
Sure. Let's do another cycle.
Yeah.
Is this cyclical or is this secular? So Uber out this morning announcing that they might invest, or they will invest in Rivian up to $1.25 billion. That's through the end of the decade. They're going to buy 10,000 Rivians now for their autonomous fleet. They have the option to buy another 40,000, I believe in 2030 or 2031. So we continue to see the autonomous robotaxi networks, self-driving cars generally, this feels like not a cyclical thing. Like, this is the future. And however many Rivians Uber buys, you know, 5 years out, 10 years out, however that gets done, it feels like we are just seeing a trend now of fewer drivers in cars with roughly the same, if not more, cars on the roads.
Although it's ironic that this comes the same week that a guy who worked at Uber, who was doing self-driving in Tesla, the self-driving crashed the car. He wrote about it in The Atlantic this week. So it's kind of ironic. Like, yes, this feels like the future, but it feels like it's, I think it's going to be a little rockier than the perhaps proponents or bulls on this would.
Really?
Yeah.
I don't think so.
I think if there's.
I don't think so.
I think crashes and stuff are going to slow this down a little bit from a regulatory perspective, to some extent. I don't know.
I don't think so. I think that ship. I think that's like a pre-COVID thing. Well, not so the ship has sailed. It's like, you know, there were plenty of stories about those initial Waymo tests when they had the really small gated area. I think it was in Phoenix back in the pre-COVID era, and like there were a couple of pedestrian accidents around some of this. Like that. Like, I don't think anyone thinks that there's going to be zero accidents with self-driving cars, but the societal acceptance of that's now a risk that we're willing to tolerate, and companies are so much better with the technology of those features being safe.
Right.
Yeah, I feel like we're past the point of, I don't want to dump on it too hard, but like, oh, that story in the Atlantic's really slowing down adoption of Waymos in City X. Like, I just don't feel like that's a 2026 thing.
Yeah, I don't know. I feel like if the technology has gotten that much better and you still have these kinds of situations, I don't know. I guess we'll see. I mean, the other interesting thing to me about this Uber situation is, as far as I can understand, I mean, Uber's done these they bought a bunch of these from different companies.
Yep.
I think this is the first one they're investing in, if I'm understanding that correctly. But in any case, it's interesting from that perspective too. Like, it continues this trend of like, I'm big on the NVIDIA trend of like investing in companies.
I did think of this when I saw this headline.
Yes,
I was like, here
investing
we go.
in companies that are also a client or that you have this business relationship with, and this is yet another example of that, which is sort of an interesting one. To be frank, I didn't even know that that Rivian was working on it. I mean, of course they're working on autonomy because everybody is.
Yeah.
But I hadn't followed their particular autonomous journey.
Well, I mean, I think that is, the idea that table stakes is now, or that autonomy is now a table stakes part of any auto company's development, and a newer company that's more technologically forward, Rivian being this company, than some of its incumbent peers. It makes total sense that they're going to be on the leading edge of this. They obviously have the commercial fleet, which they've done a lot of work with Amazon on that. So with the electrification there, and I mean, I think both technologically and just from both a consumer and a business mindset, electrification feels like it's tied really closely with self-driving cars.
Yeah.
What's interesting is that consumer demand for electric cars has really fallen off. People who are driving cars would prefer to drive a gas car, it seems, or rather not pay the premium to drive the electric car. But when you're operating a fleet of cars that don't have drivers, it does feel like electrification is going to be the answer there, long term.
Yeah, I've heard some explanation that autonomy goes better with electric cars, but I don't remember what the full explanation of how that works is.
I could guess at it, but I'd rather.
It makes sense.
The people need to hear my guesses on
some
driving stuff.
level.
You're always on cruise control, so I don't know, something like that.
Something like that. Yeah. Should we double back to AI? Shall we?
Yeah, let's do it.
Okay. So
we have a graphic for this, right?
I think we have a graphic.
We have a full screen.
Which part do we have the full screen on?
There we go. Employees at Big Four. Right.
Oh, okay. There we go. Okay, so these are global employees, by the way, not just in the United States, but you are the one who flagged a story in the FT that quotes the U.S. CEO of PwC, one of the Big Four, which is listed here as having more than 350,000 employees, that if you don't use AI, your days are numbered at PwC. You better be using it. And this is just the latest example of it's a push, not a pull, right? It's something that you must use. It's not something that employees are clamoring for, but this obviously takes it a step further, that you're in trouble if you're not using it.
Well, it's something that their clients are clamoring for, because now if you're a large corporation engaging, or they usually would have some kind of standing arrangement with this with a consulting firm, but if you're bringing in consultants to work on some project, you're probably not going to your finance department to say this is not AI related. Those investments now, the things you're exploring, those are all AI related from the client side. So then if you're on the the provider side, you're on the consultant side, you need your staff to be only thinking AI first, because that's the answer that the client needs to get to. They need to get to the AI answer. I think what's interesting about how quickly these firms, because these firms basically hire talented generalists from really good schools. And a large portion of their workforce is going to come in, do a few years, and then go on to other things. But they bring in really talented kids who can kind of just figure stuff out. So they're like, everyone's got to figure AI out now, and figure it out now because our clients need to figure it out now. The question is, one, how long does that cycle last? Two, I would say, what are the results? But that never really, it kind of matters, but it doesn't really matter that much. But then three, how does this feed through to the dynamic white-collar workforce that these firms are all feeder systems for? Because on the other side, a lot of their clients are now saying, well, we're not hiring as much because of AI, or all the best firms are doing layoffs because of AI. So now you've got this self-obsolescence mixed with, yes, but we need to maintain the business now. Again, contradictions are sort of popping up to me everywhere in AI. It feels like that's going to be the AI story of 26, which is just the two sides don't really feel like they add up in a really coherent way.
Yeah, I think that's right. I mean, whatever the case is, like that, those numbers that we just saw are inevitably going to be smaller a year from now, 6 months from now, even. You know, that in terms of the number
So that's
of
an interesting
people.
question. I mean, I don't know. I guess what I've never 100% figured out, only because it's too cynical to be like every company wants to employ fewer people, which is something that I say. It just feels like it can't be quite right. But if you're, but like I guess on the macro scale, like maybe that's true. I just don't feel like, as a big consultancy trying to win business from all these different clients who are trying to find AI solutions, I don't know if what you want to put out there is like, and now we have 10% fewer people because of AI. Because then the project you're pitching is one note. It's, hey, you can bring in AI to cut your workforce.
Right,
I think there's a lot of companies who probably want to get good AI solutions to grow the business so they can invest. Like the
At
idea
some point,
that
that's going to have to be the
right.
pitch,
The idea of just manage the bottom line and cut to the bone, like that's just not going to work long term. That's what the cycle demands right now, but that's not a healthy trajectory for all these businesses.
Yeah, I mean, and I guess the other thing is that some of the big four are private, so they also have that also implies different calculus than having to answer
partnership structure versus a public
than
company
having to answer to
structure.
shareholders and having to cut. But yeah, I buy what you're saying. I mean, you also need people. Like AI doesn't sell itself.
Yeah, right.
Right? We're not there. I mean, maybe at some point we'll be there, I guess. But like all of these AI tools, you still need a human to talk to another human about how great all of this is and how much they need it.
Yeah, and I mean, I think we would have this view being like on what is essentially, like we're essentially within the marketing arm of a tech company, right? No, I mean, that's like the function. And the number one functions that a lot of leaders want to get rid of is sales and marketing. Because it's like, I don't know what those guys do. You know, they have conversations. Oh, they went to a client dinner. Like, let's just not do that stuff anymore. And I think it can be fine to keep existing business or even grow it a little bit if you have none of these creative, design, like any of these functions. But you can't grow a company without, like, there's a reason why that holistic stack of what you usually have as a large employer, like, there's a reason why it exists. And I do feel like, you know, we will see a lot more job cuts. And eventually, one company is going to come out and be like, I don't know, I don't think that really worked out for us, having 0 salespeople anymore, or having the whole sales funnel go through like 3 people instead of 40 or whatever it was.
Yeah.
I do feel like it will go too far. But the environment right now is going to give you that overhead to cut too far and then undo it in 3 or 4 years.
Yeah, we'll see how it plays out. All right, well, that does it for Miles and I. Futures are still down, although not down quite as much as they were earlier. We continue to watch oil prices. Metals, not just gold, are rolling over big time today. Aluminum is down quite a bit.
We ran out of time to do your bracket, too. Devastating to me.
Sure. If you ask me who's going to win it all, Miles, I don't know. Okay,
I
all
don't
right.
really care either.
Opening bid is next.
I care more than you.
With Brian Sozzi. True.
All the good times that come from more me time. All the wonder of what the night could bring. All the energy to turn your world around. It's all
And they're saying, Brian, I don't need as many people in my jobs. I just had a convo with Circle CEO, Jeremy Allaire. He's like, I have 1,200 employees. Everyone is trained on AI, but it's likely that I may not need 1,200 employees, not over the next 2 years. I mean, he's thinking about potential changes in 6 months. I see what Block has done, laid off 40% of their staff. I mean, there's another side to this, though.
I think the jobs to be done is what we as leaders need to be asking ourselves. Where is the automation opportunity? And there is automation opportunity, maybe not for all of a job, but for tasks associated with the job. There's augmentation opportunity, and then there's the addition opportunity. So our opportunity is to be better at being human, the creativity, the judgment, the ethics, the integrity, the discernment, the taste that comes from the application of human skills. That's what we as leaders have got to be focused on.
Lastly, leaders coming into this year, I imagine what's happening with Iran was not on anybody's bingo card. It wasn't certainly on mine. Has it changed how you lead the company? How do you adapt to what might be or might already is an economic shock?
Well, our company has served millions of clients for 104 years. So we have served and advised through 100% of those geopolitical shocks, the up and down in the markets, those unforeseen circumstances, and we'll continue to do that with calm, with an intention focused on the needs of our clients, family by family. We'll use that same playbook, we'll be adaptable, and we'll give advice that relieves anxiety.
Thank you, as always, for the incredible insights, Penny. I appreciate it. Thanks for making time for me. It's a full day of power players at Opening Bid. You just heard Penny with some awesome insight on markets and really, frankly, life. And I know my next guest will be equally as awesome. Gary Cohen steps up to the Opening Bid. Mike, next.
Our firm represents individuals who are charged with criminal offenses, including DWI and all other state and federal crimes. I think what makes our firm unique is not only the training that all my lawyers go through. For those handling DWI cases are trained in field sobriety tests, drug recognition, forensic chromatography, you name it. If it's involved in a DWI defense, they're trained in it. So my attorneys are in trial constantly. They're extremely aggressive, but also extremely empathetic. We're gonna help you any way we can.
All the good times that come from more me time. All the wonder of what the night could bring. All the energy to turn your world around. It's all here, where simply walking in feels like a win. Get away to it all at Choctaw Casino and Resort Durant.
Hello, Panda!
Want to add some pandemonium to your practice?
Maybe Hello, Panda!
Add more years to your life and more life to your years. Join Whoop today.
Sorry, folks, we're stuck. Tour's over.
It's over?
Here, hold my oikos.
Let's move!
Oh, hey there, big fella.
My oikos! Your oikos! Let's move!
Oikos is packed with complete protein to help build strong muscles.
New Haagen-Dazs Belgian waffle cones. Save the best for last. That's Dazs.
Make a move. I dare you.
With Ring, you can protect your home from anywhere.
The power of paralyzed veterans of America can be felt everywhere. For over 80 years, PVA has been a relentless ally for veterans with spinal cord injuries and diseases like MS and ALS, and all people with disabilities, empowering them with the support they need to build the futures they deserve, so they can gain the freedom and independence to thrive. That's the power of PVA.
Choose from thousands of realistic voices to use in your content. Change the way you record podcasts, voiceovers, and branded content with the #1 AI-powered voice generating technology. Stop searching for the perfect voice and stop wasting time re-recording take after take. Try 11 Labs for free and start elevating your content today.
What's interesting about it is that the most technologically advanced firms are actually reducing their headcount faster than anyone else, which is a pretty interesting tell. For many organizations, I think they will find that they certainly don't need to hire people, or they need to hire much more selectively. And there are areas where they don't need people. And they can accomplish the same objectives and maybe 10 times more with less people as well.
The thing that I think a good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector.
As the shockwaves of Operation Epic Fury continue to ripple through the global economy, we are witnessing a dual transformation of the American landscape. On the one hand, the cost of living is on the climb as higher oil prices filter through the financial statements of very large companies. Then there is the generative AI revolution as it shifts from a boardroom curiosity to a structural disruptor. The question is no longer if the job market will change, but how many millions will be caught in the transition. Here with me now is IBM Vice Chairman Gary Cohn. Gary is the former director of the National Economic Council during President Trump's first term. Gary, good to see you.
Great.
I love that you always come prepared. You got the dot plot here. I mean, that's why I love having you on.
You know, it's very nice geometric shapes.
No, it's
so
great.
I thought I'd bring it in.
No, it's awesome.
In case we want to talk about the geometry.
I also love talking to you because you talk in, you make a lot of sense to me every single time. So we heard from Chair Powell yesterday. He didn't want to commit to how higher gas prices are going to impact the economy. For the average human out there, is what we're seeing with oil prices transmitting to gas prices, is it recessionary?
It's absolutely recessionary in the short term. Like, there's nothing more instantaneous to a consumer than standing there holding down the gas nozzle and watching the numbers tick on the pump. You know, every consumer in this country knows exactly what they paid the last time they filled up their tank, what they paid a month ago. And if they were paying $80 a week ago and they're paying $85 this week and they were paying $60 a month ago, they know that I lost $20 of disposable income in filling up this tank of gas. And unlike people who live in New York City, the hardworking Americans in this country, they drive a lot of miles. They can fill up their tank 2 or 3 or 4 times a week. If you're filling up 4 times a week, that's $80 of disposable income coming out of your pocket, after-tax disposable income. That's the difference between taking your family out to dinner and not taking your family out to dinner a couple times in a week.
When does this start showing up in economic data?
I think we're starting to see it come through. Remember, we're sort of week 3, going in maybe week 4. It takes some time for the transmission mechanism to work its way through the system. The other thing that you need to understand, and you do, we in the United States, we're actually in a pretty good position. We don't have a supply issue. We have all the supply we need. In fact, we're exporting natural gas, we're exporting oil right now. The rest of the world actually has a price and a supply issue. So we know we've got the oil here. We know we've got the natural gas here. If you're in Asia or you're in Europe and you're running a government there, you're making really strategic decisions how you're going to use the oil and gas that you have. And in fact, parts of Asia right now are shutting down businesses, closing down schools, asking people to work from home, and doing all the things you would normally do to start saving and economizing on the amount of oil you consume. So in many respects, we're in a better position than most of the world right now.
I'm going to get this question, so I'm going to put it to you before I get out there on X. Are we in a recession, or we are slowing down going into one as we speak?
I think right now, we're more in a stagflationary environment. Gotcha. We don't have growth, but we have prices increasing. Now, look, the prices increasing could be relatively short term, but we don't know. The one thing about being in a geopolitical situation is you don't know when geopolitical situations change, how quickly they can change.
There's no line of sight to when this is ending.
There's no line of sight. And we are seeing businesses on the other hand, and we saw this before what's going on in the Middle East here. Businesses were starting to right-size themselves. There was this natural squeeze on profitability. So you can go back to the quarterly earnings reports a month ago, and in those quarterly earnings reports, a lot of major companies were talking about 30, 40, 50,000 layoffs. There was hundreds of thousands of pronounced layoffs in last quarter, which was Q4 earnings that are coming out now. So this trend to cut labor cost in companies has been going on for the better part of almost 6 to 8 months right now, and it's a natural phenomenon. As companies have input costs go up, commodity prices have been going up across the board prior to this war. We see labor costs going up. If you have commodity prices going up, labor costs going up, tariffs going up, you have two choices as a company. You either raise your prices or you find a way to be more efficient. Companies had been hesitant to raise prices initially, so what did they do? They got more efficient. They started laying off people. And most companies literally came out of COVID with a bloated workforce. When we were in the early 2020s and people were working from home, we weren't sure how much productivity we were getting out of our workforce.
Let's keep everybody on the books.
Right.
Yeah.
So let's hoard employees.
Yep.
So if I need an extra 20% employees to make sure I can deliver to my clients, it's okay, because right now I can charge for it. And look, we're in a time of crisis. I don't know where to hire the next person. So we went with people hoarding employees in the 2023 cycle. Then we get into this new cycle of higher input costs, and all of a sudden people realize, okay, people are back in the office. They're working 5 days a week. The productivity has gone up dramatically. I can now get done exactly what I need to get done with less people. And look, let's be honest, AI is coming in. AI is creating some of the efficiencies as well. But I don't think AI is the driver here in companies really downsizing employees. Right?
What you're saying makes a lot of sense. And at what point is it another 2 weeks, or how many more economic signals does the administration need to get before they say, you know what, let's just wrap up this war. We got to get back to growing the economy?
Yeah, look, I think the administration is acutely aware of the economic issues going on. I know that the economics will have some input into their decision making, but at this point, they're sort of committed to what they're doing, and I think they have to finish what they're doing. There's no reason to get 90% there and withdraw at this point. Let's just finish this off once and for all. We will get back to a normalized recovery. It will take some time. The one thing about recovering the oil market and the natural gas market is, it's not a day out, a day to get back. If every day you're out, you add more and more and more days to recover.
So the economy doesn't just snap back.
We're not going to snap back. That said, if we know that oil can freely move through the Straits of Hormuz, and we know that it's available, and it's just a timing of getting wells back up and getting some pipelines fixed and getting some motors fixed and replacing some of the damage, the psychology of knowing that's happening will probably affect the market more than the actual shipping of the barrel. It's always trade the news. The actual event's not that interesting.
I'm glad you're here, because I want to talk about AI too. The clip we had coming back from the show, I talked to Circle CEO Jeremy Allaire at the New York Economic Club, and he was saying, look, we're like 6 months away from a massive change in the labor force because of AI proliferation and a spike in unemployment. Like, do you see that, and how bad could this get, and how quickly?
Like, I don't know about a 6 month of anything. So making these predictions on 6 months.
You scared the
here's
shit out
about this. I'll make a bold prediction. I don't think he's right.
Yep.
It could be 4 months, could be 12 months, but 6 months.
But it's coming.
Like, it's coming in some respects, yes. But there's also new opportunities being created. The one thing I always point out to people, if you go back in the history of this country, go back in the history of the world, go back in the history of this country, and show me a major technological advancement that didn't overall grow levels of employment. Because when you create a major technical advancement, what do? You create productivity. When you create productivity, you create a larger economy, you create a larger GDP, and we need more people. Now, we may need them in completely different jobs. So, back in the cotton gin days, we needed people picking cotton and sorting it. We don't need those anymore. Back in the horse and buggy day, we needed people managing stalls, shoeing horses, feeding horses. We didn't need that. But lo and behold, the internal combustion engine came, and we needed people fixing those internal combustion engines. And in fact, there were a lot more internal combustion engines than there were horses because the economy grew. Sure. Even when you get back to the internet, I remember when we got internet and we got email. And everyone looked around the floor of the office and said, well, what are all those people going to do? That person there prints memos, puts them in my mailbox, and tells me what time to be at a meeting today. Well, that person's job lasted about an hour when I got email. But every company that got email is probably 2 or 3 times bigger today because they have a much bigger geographical footprint, because now I can talk to you real time on email. I can communicate across the world. So, look, I'm not saying there won't be just some disruption. There will be some disruption in employment. But I think at the end of the day, we will need different skills, and we will continue to need people to make sure our economy grows.
What happens to the displaced humans? I've heard some folks, they've just told me, Brian, we need some form of universal basic income for displaced AI workers. And is that even a possibility?
Look, I think displaced workers will be retrained, and they'll get other jobs. They were talking about things like this when the horse and buggy went out, when the internal combustion engine came in. They were talking about things like this many times in the event. There's always this natural reaction that it's going to be horrible, it's going to be bad, it's going to be the end of civilization, it's going to be the end of the way we live. It's not. It's going to be different. And you know what? Different could be a lot better. If the economy grows dramatically, we are going to need a lot more service people. You still can't use an AI machine to fix my sink, fix my lights. Try and get.
You see those robots in people's kitchens.
Well, but try and get a plumber in the city.
Yeah.
Try and get a plumber anywhere in the country. Try and get a carpenter.
Yeah.
Try and get an electrician. These are skill sets that are still going to be needed. And think of all the building we're doing of data centers. Think of all the building we're doing of power facilities. They're not going to be built by machines. They're going to be built by human hands. We're going to need hands that are trained.
Gary, so good to see you. I wish we could take an AI agent and redo the look of these government data websites, because they really suck. I mean, they're just awful. I mean, that's nice. So that was a nice.
Yeah, that was nice.
It's a nice print.
This was put out by individuals.
Yeah, that's why it looks so nice. All right, I appreciate it, Gary. Thank you so much. All right, the big combos keep on rolling over on my Opening Bid Unfiltered podcast. I'm a busy guy. In a new episode out today, I sat down with venture capitalist and HP Inc. board member Sanjay Noon, and she told me what her outlook is for the future of AI. Julie Hyman has you on the other side of the break.
All the good times that come from more me time. All the wonder of what the night could bring. All the energy to turn your world around. It's all here, where simply walking in feels like a win. Get away to it all at Choctaw Casino and Resort Durant.
Add more years to your life and more life to your years. Join Whoop today.
Go back 400 years in a single afternoon.
Activia deliciously supports gut health in 1, 2, 3. Gut friendly with daily nutrients. 2. Helps digestive health. Yeah, I'm doing it. 3. Probiotics by the billions. I'm not new to it. Activia, your gut is where it all begins.
I'm Jamie, founder of Ring. Our latest invention, Retinal Vision. AI tuning delivers ultimate clarity for unmatched security. Protect your home like I do with Retinal Vision on new 4K cameras and doorbells from Ring. Shop now at ring.com.
Can I ask you a question?
Sure thing.
How much do you spend on groceries per week?
Like $150, $200. 200, I think.
Like $350. $350! You enjoy cooking?
No, but I do it.
And if I told you that you can have award-winning chefs prepare your meals every single week and have everything delivered to your doorstep for much less than what you're spending on groceries right now, what would you say?
No, I wouldn't believe you.
Cook Unity lets you enjoy meals from award-winning chefs. No cookie, no cleanup, just real chef-made food delivered to you every week.
And we're 30 minutes into the U.S. trading day. So let's take a look at the major averages. It has been an eventful day in the markets, although we were down much more in futures than we are down now in equities. But there are a lot of cross-asset moves that are really interesting today. So first of all, let's get to stocks here, because we do see this pullback of about 200 points in the Dow, about 0.5% in the S&P 500, and call it 2/3 in the NASDAQ. I want to look at the two-day chart as well here, because that encapsulates also the reaction to the Federal Reserve decision and then, of course, press conference yesterday, which is being read somewhat hawkishly here. So we saw that sort of fade through the press conference yesterday and not seeing any kind of recovery today. Indeed, we are seeing a continuation of the selling that we saw yesterday. This is also manifesting in the Treasury market, where we are seeing some really interesting moves here. The 10-year move upward yesterday, not much, but today we are seeing a little bit more of a move. The move is more acute on the 2-year end, which we don't have here, but it's a bigger move on that side, as we are seeing some traders erase their bets that we will get any kind of rate cut this year, or maybe not as many as they had been anticipating. Bitcoin prices are pulling back right now. We have the euro a little bit higher versus the dollar, so a little bit of dollar weakness today. And then you've got what's going on, of course, continuing to go on in crude oil prices. Now, this is WTI, where we're not seeing that much movement here, but just to switch on over to our commodity boards, there's crude. WTI. Here's Brent, which remains above $100 a barrel. It touched much higher levels, as you can see earlier in the session here, as people continue to watch as the war unfolds in the Mideast, with Iran doing some retaliatory strikes after the attack on its natural gas field. So that definitely is something that the market continues to pay a lot of attention to. As our Jake Conley has been reporting, the physical prices for crude right now are considerably higher than what we're seeing in the futures market. So that's something to watch as well. And then there is metal today, and we are seeing a pretty broad pullback in the metals markets. Copper futures are falling. We don't have aluminum on here, but believe you me, aluminum is, we do have aluminum on here. Here it is. It's down 6% today. Gold futures, although obviously not as much an industrial metal, is also trading sharply lower. So really seeing quite of a sell-off on the materials side. As you might imagine, that's also feeding through to equities. Here's the materials sector, which is down 1.7%. Industrials also taking a hit, along with consumer discretionary. On the upside, we got energy, which has been doing well, along with oil prices. And we also have tech to some extent, or at least communication services, that's up a little bit. So it looks more mixed under the surface than it does if you just looked at what the market is doing today. And of course, some of this comes back to the Fed. A lot of it comes back to oil prices. Let's try to make sense of all of this with Brett Ryan, Deutsche Bank senior U.S. economist, who is joining me in the studio. Brett, obviously we are all grappling with the same thing that the Fed is grappling with, which is we don't know how long this is going to last. We don't know how long oil prices are going to remain at these levels. And that seems to be really the key. And it seemed, Jay Powell, in true Jay Powell fashion yesterday, was sort of said, we don't know how this is going to turn out, right? So how do we all try to get through this period then?
Sure. So I think Jay Powell's best line from yesterday was, when talking about the SEP forecast, said several participants had told him if there was one time we could skip the forecast, it would be this one.
Yeah.
And that's essentially what the message was, is that This presents risks to both sides of the dual mandate, inflationary and growth. But to the extent that we don't know how long this is going to last, that's it's too early to say what the preponderant risk is going to be. Right now, the market's saying it's inflation because it's simply we've taken out a substantial amount of cuts. We were pricing 60 basis points of cuts going into the event. Now we're pricing around 20 basis points of cuts by the end of the year. So that's telling you the market's saying this isn't a recession risk, this is an inflation risk right now. Now that could switch, right? Like the same thing happened with break-evens going into Liberation Day last year. Break-evens are rising, 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 then all of a sudden they plummet because then it goes from inflation to a growth risk. We're not at that point yet. What we looked at is, for consumers, right, the gas price matters, as Gary Cohen talked about earlier. And for every $10 rise in oil prices, it's about 25 cents per gallon at the pump. Every 1 penny per gallon at the pump is $1.15 billion in consumer spending on energy. So, quote unquote, the energy tax, if you will. At $100 oil, the implied rise in gasoline prices, and we've realized about 90% of it at this point, would be about, let's call it, it's about 100 cents of $1. 115 billion. That hurts, but you have to remember that's the backdrop of 60 billion to 100 billion in tax refunds coming from 2025, on top of 130 billion of tax benefits from lower withholding this year. So it's the context of this.
Is it a wash, or
just about at 100, where it starts to, overtake the benefits from the tax bill? Is around $140, $150 oil.
I mean, the thing is, it's not just gasoline prices at the pump, right? It's the prices that companies are paying to ship everything, right? Diesel prices, as we know, have gone above $5 a gallon now. And it's also fertilizer that goes, so we're talking about food prices potentially and an impact there. I saw one estimate this morning from an economist of CPI for the next few months of 3.5% at the headline.
Yeah. I mean, that's one reason the Fed took up their inflation expectations on headline. We took up ours as well. We're about 3.3% at the peak. The other second-order effects, though, I think that are less talked about, but it should be. Let's take the AI build-out that we're all very much excited about. When I look at the CapEx spend of the top four, Amazon, Meta, Microsoft, and Google and Alphabet, their growth rate of CapEx is about $250 billion versus last year, and the growth rate's about 64%. If Taiwan is starved of energy resources, starved of helium to make, for a significant period of time, that's going to slow the CapEx build out. And so, those are the things that I think, we're also watching in addition to the consumer side of the story, is the second order effects further down the supply chain that begin to impact things like CapEx and how fast those guys can build out their AI systems.
Well, and it's not just the building, it's the operation too, because if you're powering those data centers, for a lot of them, it's natural gas. And natural gas prices, they're affected less here than, than
natural gas
it's
here,
a more local market. But nonetheless.
Yeah, Europe is more impacted by natural gas prices. They'll have to bid for U.S. Liquid natural gas against Asia. We're somewhat insulated from that. But at the end of the day, oil is a global market, and the crude is a global market. Our refineries are set up more to process the heavy crude from places like Venezuela, so that's a somewhat positive, and that limits the rise. But at the end of the day, like an export ban isn't going to help you, and a gas tax holiday, it helps a little bit in the margin, but that encourages more consumption, which is not what you exactly want to do. And so the options here for policymakers to limit the pain for consumers are kind of limited. And therefore, it comes down to how fast does this continue? The market's saying right now it's about 2 months for the Strait of Hormuz to open and for energy to start flowing again. It's going to take several weeks. Once the security situation has been stabilized, it's going to take several weeks to open these gas fields, to open these oil fields. So I would say maybe the market started off optimistic. It's now gone to a more pessimistic view. but there could be more to go, depending on how long this takes. And keep in mind, the administration is going to have to go to Congress at some point to get authorization for additional funding from for the Pentagon.
Right.
The Pentagon's asking for $200 billion, and the 1973 War Powers Act, they are supposed to go to Congress within 60 days. So
They're
2
supposed
months.
to do a lot of things. We'll
Yeah.
see if how that ends up
Right,
playing
but
out.
I think the market is kind of settled on this sort of 2-month time frame, and it's important for the administration to manage expectations properly around that.
Just to follow up on the data centers and another maybe second order effect, do you expect any decrease, mitigation on the margins of investment from the Mideast? Because the investment from there into these data center companies to do build outs there has been big.
Right, that's an excellent point. And they have their own data centers to try to secure right now,
right,
which they're trying to get help from Ukraine on. So no doubt, it probably puts a pause on some of these investments in the U.S. And keep in mind, when you talk about an energy export ban to, help mitigate prices for U.S. consumers,
we don't have the kind of oil that
we have a lot of oil, but it's not the oil that you need. Yeah,
that's right.
But the other thing is, you just cut all these trade deals in which energy purchases were part of the trade deal. For Japan, for example, for Korea, the whole part, they were supposed to purchase 100 billion of energy. So, you run into a lot of problems there. And so at the end of the day, what matters is getting the Strait of Hormuz open and consistently. And right now, there isn't any visibility on that. The market's making a call of around 2 to 3 months, I would say. But if the market starts to think that it's going to take longer, then you're looking at a move of oil to 150 or so, and then it begins to really bite on consumers.
Okay, so just then one follow-up question. You said at the beginning the market is pricing in more of a risk to inflation than to growth. First of all, is the market right? And secondly, if it is, what would change? What would tip us over into being more of a growth concern than an inflation concern?
Yeah, I think at 150 oil, then it becomes more deleterious and drag on the consumer spending story, because you're more than taking care of all the tax benefits, the fiscal tailwind you have behind you, right? Right now, consumers are getting their tax refunds. They're about $1,000. Or 10.6% more than they were this time last year, about $1,000 more. And so they're like, I can handle a month or two of higher gas prices. Beyond that, it starts to bite. And so if you really get into 150 oil, then it's a problem. What you look at is break-evens. So the 2-year, 5-year inflation break-even expectations. What happens is there reaches a point where they stop going up, it's up inflationary, and they start going down, because it's a growth story now. And that's what happened with Liberation Day last year.
So break-evens are the thing to watch.
Keep an eye on that. That's what the market's going to be that's sort of your tell when it switches from an inflation story to growth story.
Brett, thanks so much. Good to see you.
Pleasure having you.
And checking in on where prediction markets see the interest rates this year, the majority of bettors are predicting 0 rate cuts this year at the current time. Well, majority. It's a slim majority. For more Poly Market odds, you can scan the QR code on your screen to go to the Yahoo Finance Prediction Markets Hub, powered by Poly Market. Well, the Federal Reserve out with a long-awaited proposal to rewrite capital rules, potentially unleashing billions of dollars for lending, share buybacks, and dividends for big banks. Joining us for more, Yahoo Finance Fed correspondent Jennifer Schonberger. So, Jennifer, what did we learn?
Hey there, Julie. Good morning. That's right. A new long-awaited proposal from the Fed would tweak financial crisis-era capital requirements, reducing banks' cash cushions to realign with the economy and aiming to boost lending. This is that long-awaited Basel III requirement that was supposed to come out post-2008 financial crisis to align with international capital standards, but also customized to U.S. banks. It has gone through numerous iterations since then. It also incorporates changes to stress tests and a capital surcharge for the largest U.S. banks. And under these combined proposals on net, the largest U.S. banks would see their capital cushions or capital requirement drop by 4.8%. Those are banks like J.P. Morgan and Goldman Sachs. The next tranche of banks, those with assets of between $700 billion to $100 billion, would see their capital requirements drop by 5.2%. And then the smaller banks, those with assets of $100 billion or less, would see their capital requirements drop by 7.8%. Still, even with these reductions in capital requirements, the largest banks in the U.S. would still have an excess of $800 billion to guard against any losses should there be a recession or a financial crisis. And capital levels would still be twice the level of what we had pre-financial crisis. Now, the Federal Reserve's top cop, Michelle Bowman, Vice Chair of Supervision, who has been spearheading these changes, said, look, they were well-intentioned when regulators put in place these regulations post-financial crisis in 2008, but there have been unintended consequences. And so today's rules are really aimed at recalibrating so that we see lending that had unintentionally gone into the non-bank sector, namely mortgage lending and some business lending, that's aimed at trying to bring it back into the regulator's purview, back into the traditional banking sector. Not everybody agrees with today's proposal. Unsurprisingly, Fed Governor Michael Barr has objected to this. He, of course, was the vice chair of supervision before Michelle Bowman, and was known for putting forth a very stringent capital requirement proposal for Basel III. He called this unnecessary and unwise. He said it would harm the resilience of banks in the U.S. financial system.
So what does this mean for the banks?
Look, I think on net, it doesn't change their calibration all that much in terms of the capital that they're required to retain. But what it does is it simplifies the calculations. Instead of having to do two calculations, now they have to do one. So that's less burdensome for them. That's less cost intensive for them. That frees up cash and capital for them that they can start lending out into the economy. So what I would expect lending to pick up as a result of this. Haven't spoken to the banks yet, but we'll see what their reaction is.
Jennifer, thanks a lot. We shall see indeed. Appreciate it. Coming up, Micron reported record results, but the shares might not be performing like you would think. We'll dive into the numbers next on Market Catalysts.
Texans know for selection and lower prices, it all starts at Specs. No matter what's on the menu, we've got you covered. With all your favorites on tap, you'll bring home the win. Special occasion? Flirt responsibly. Boots on, drinks up. The fun starts here.
Shout Specs, low priced, amazing. Here's to you. Shout. Cheers to savings.
All the good times that come from more me time. All the wonder of what the night could bring. All the energy to turn your world around. It's all here, where simply walking in feels like a win. Get away to it all at Choctaw Casino and Resort Durant.
Go back 400 years in a single afternoon.
For the ones working to make every day a little sweeter, there's Grainger, for the ones who get it done.
The power of paralyzed veterans of America can be felt everywhere. For over 80 years, PVA has been a relentless ally for veterans with spinal cord injuries and diseases like MS and ALS, and all people with disabilities, empowering them with the support they need to build the futures they deserve, so they can gain the freedom and independence to thrive. That's the power of PVA.
I'm Jamie, founder of Ring. Our latest invention, Retinal Vision. AI tuning delivers ultimate clarity for unmatched security. Protect your home like I do with Retinal Vision on new 4K cameras and doorbells from Ring. Shop now at ring.com.
Imagine being able to build anything just by thinking about it. Meet Base 44, a complete AI creation platform made for anyone with an idea and a drive to bring it to life. Describe what you want and watch it take shape. You can plan, customize, and expand in any direction. From tools built for one to platforms ready for many. From passion projects to enterprise-grade systems. Everything is built in and ready to launch. It's a new world of creation, where you can go as far as your imagination takes you. Can you imagine it? Let's make your dream a reality, right now.
Micron reporting blowout second quarter results. Revenue nearly tripled last quarter. Of course, it was boosted by AI-driven memory demand, but the shares are down about 3.5%. The company's planning to spend more. There's some concern about margins. Let's see what Chris Shanker is thinking about. TD Cowen Managing Director. He's joining us now. Chris, it's good to see you. So, you know, we're in this market where sometimes the results can be perfect, and there's still disappointment, especially after a run like Micron has had. But I have seen a few fundamental concerns here about Micron. What are you thinking about? Are you concerned about anything that the company said?
Yeah, thanks for having me, Julie. I would definitely say that there are a couple of investor concerns. I'm not too worried about it, to be honest, because I do believe that the fundamentals are still pretty robust. You obviously saw the phenomenal beat and raise that they had last evening. I think the two main investor concerns seem to be, number one, the gross margins are getting close to peak levels, and the stock might peak along with gross margins. Second one is the increased spending, which eventually could add incremental more supply, has some impact on pricing, and along the same path, you know, higher capex could be future higher D&A, having an impact on margins. So I would probably say that clearly the demand is very strong, supply is very constrained. I think people just look at it on a unit by unit basis, but I would say that, you know, as supply comes online, yeah, it does have it does increase the number of bits in the marketplace, but if the demand is very strong enough to absorb it, then I think you can still have a very longer duration sustained cycle than in prior scenarios where things rolled over right away.
So it's interesting to me that you're still using the word cycle, right? Because I think there among some, or there at least it's been debated, are we in this sort of post-cycle, post-memory cycle environment because of this huge demand for high bandwidth memory that Micron is making? Are we in that environment, or are the cycles just like more muted, longer maybe? What do you think?
Yeah, you know, it's a very valid question. What I would say is that, you know, memory cycles kind of like, you know, evolve over time. What you're seeing right now is clearly strength from your legacy DRAM along with HBM. HBM tends to be more longer-term contracted out, so I think that seems to be a little more stable and relatively less cyclical compared to your traditional DDR5, DDR4 memory. But I would say that, you know, at the end of the day, I think if you just take a holistic view, you know, we are in like, you know, what are you going to call it, a memory super cycle, if things are different structurally. But at the end of the day, I think, you know, I would probably say that, you know, things are definitely in a very different dynamic today, which is extremely good for memory. But I would always say that, you know, just keep in mind that there are 3 players in this market who are actually, excluding the Chinese, who are actually producing. So it always like makes sense to be a little on the cautious side from that. But I would probably say that when I look at it through that lens, of a cyclical lens, I'm not worried about the cycle in 2026. Not really worried about it in 2027 yet. 2028, we don't really have any visibility to make a judgmental call. But right now, I think 26 pricing is looking good, and demand is looking pretty robust for 2027.
And it seems like you also believe, when it comes to Micron, that there's further upside for the stock.
That is right. So, you know, one of the things that I would say is that, you know, we looked at our numbers, we raised our EPS for next year, calendar 27. Into the print, we're at $90 EPS. Now we're at 110. The thing that is always interesting with Micron, and I also brought the fact that, you know, people worry about peak gross margins. You know, the stock really trades on the out earnings is basically a peak earnings. So I'm going to put a trough multiple on that. And I think that is one thing which probably needs to change. hopefully will change maybe during this period of time or into next year, when people realize that earnings is more durable and more sustainable than in prior cycles where it either went up or down. So I think even if you take conservatively a 5 times multiple on our $110 EPS, that's a $550 stock compared to where the stock is today, in $430, $435, somewhere in that range.
Krish, I was talking to an economist a few moments ago about something, and I want to get your take on it. He was talking about the risk from the Iran war, not just to things like energy prices, but also the risk that it can disrupt this supply chain, the AI supply chain, as it were. You know, maybe whether it's helium that, you know, is used in some of these manufacturing processes, not getting to Taiwan where it needs to be. And I wonder if you think that that's a risk at all for the data center build out.
Yeah, you know, I mean, I think that's, to be honest, like, you know, a question that's beyond above my pay grade, I would say, because it's more about macro. From what we heard from semi companies, it seems like not an issue yet. We'll have to see. You know, a similar thing came up a few years ago during the when the war in Ukraine started, and there were some concerns around some of these gases delivery to semiconductor fabs. Didn't turn out to be an issue. Some of them do have buffer stock and things like that. But again, you know, at least so far what we have heard is at least the semi companies are saying it's fine. I don't know how these things change on a day-to-day basis.
Krish, great to see you. Thanks so much for your perspective.
Thank you.
Thanks. Coming up, we'll get the top analyst calls on Wall Street and look at some of today's trending tickers. Stay tuned. You're watching Market Catalysts.
Up to 50,000 cars added daily on Cars.com. Where to next?
So, meaning solution, I feel like really...
Guys, the internet is going down.
Oh no, the spinning wheels are coming.
Fear not. I, Signal, am here to keep the Wi-Fi up and running with my backup cellular connection.
You just fixed the Wi-Fi?
Automatically.
Are you always going to talk like that?
Excuse me?
It just sounded a little fake.
Fine. No, I just wanted to sound heroic.
You'll always be my hero, bro.
Thanks, bro.
Activia deliciously supports gut health in 1, 2, 3. Gut friendly with daily nutrients. Helps digestive health. Yeah, I'm doing it. 3. Probiotics by the billions. I'm not new to it. Activia, your gut is where it all begins.
I strip on sick days.
Breathe Right strips have spring-like bands that open your nose, instantly relieving nasal congestion. So every breath feels... ah.
New Haagen-Dazs Belgian waffle cones. Save the best for last. That's Dazs.
Hey, Ryan Reynolds here from Mint Mobile. You know, I first ditched big wireless and started using Mint Mobile way back in 2019. Back then, you could get premium wireless for only $15 a month. Today, Mint Mobile's premium wireless has gone up by, okay, wow, that's it, zero. It's gone up $0 a month since 2019. That doesn't seem fiscally responsible to me, but again, you know, you're welcome. And I'm not an accountant. Hate math, always hated math. True story, I was in math 10A when I was in 12th grade.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ here in Times Square today. Let's turn now to some of today's top analyst calls on Wall Street. We're watching SanDisk, Union Pacific, and Five Below. First up, let's take a look at SanDisk. Citi raised its price target to $875 from $750 following Micron's results. Micron executives told investors on a call that they expect demand for memory storage chips to grow by roughly 20% this year alone, and that tight conditions will extend beyond just this year. The analyst said the read-through for SanDisk is that it could benefit as memory demand in data centers outpaces available supply for the foreseeable future. The street is bullish on this one. There are 18 buys, 6 holds, and 1 sell. Next up, Union Pacific. Evercore ISI upgraded the stock to outperform. The analyst said he thinks the railroad company is operating at an elite level, which is translating into strong volume growth and robust margins. He did say that the impact of higher fuel costs will be roughly 10 cents per share on the company's first quarter earnings results, but he isn't too worried. He expects that to be offset by much stronger revenue and a well-running network. The street likes this stock too. There are 20 buys, 7 holds, and no sells. Last up, let's take a look at Five Below. William Blair upgraded the stock to outperform from market perform. The off-price retailer beat the street's estimates for its fourth quarter results and first quarter forecast. And the analyst said he is more and more confident that Five Below maintains plenty of levers to grow year over year and beat the street's forecast in upcoming reports. Meanwhile, Deutsche Bank, UBS, Guggenheim, Bernstein, Barclays, and Telsey Advisory Group, just a few, all raised their price targets on the stock. Joe Feldman over at Telsey said that store growth and consumers' focus on value will benefit the chain too. The average 12-month price target is now roughly $260. Keep right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the session.
Let's get to some of today's other trending tickers. We're taking a look at Alibaba, Accenture, and Align Technology. And Jared Blickery is with me, markets and data editor. Let's talk about Alibaba first. Of course, the Chinese e-commerce giant. It did report weaker than expected revenue, but the company also said it's going to get to quintuple its cloud and AI revenue. $100 billion annually in 5 years is the company's aim here.
Yes.
But the shares are pulling back a little bit, so it looks like XAI, not XAI, Elon Musk's XAI.
Yeah.
Excluding AI, the business is not as strong.
They still got to sell stuff.
Yes.
And the problem is there's this brutal competition in that industry in e-commerce in China. Not a surprise there. So let's go over some of the earnings highlights. AI cloud is still the part that works. So cloud revenue up 36%, AI-related product revenue, triple-digit growth for 10 consecutive quarters. The company says the business goal of Alibaba's AI strategy is very clear. Over the next 5 years, our goal is to surpass $100 billion in combined cloud and AI external revenue, what you were just talking about, Julie. Core results were weak enough to overpower that AI pitch, though. So revenue was up 2% to 285 billion yuan. Net income down 67%. So that's a big drop in profits. So Alibaba needs a number of things to kind of fall into place. The monetization story is still not really convincing yet. AI revenue goal implies roughly 35% annual growth. E-commerce and food delivery still the main earnings drivers, but we talked about those headwinds being so much competition there. Bloomberg Intelligence saying Alibaba's push into agentic AI and creation of Token Hub will not alter the e-commerce giant's AI profit outlook, which remains challenged. So stock is down 6.4%. If we go to the Wi-Fi Interactive, I think a 6-year.
Stock is kind of meh.
Yeah,
more
let's go.
Recently.
6 years will give you the 2020 peak. That was, I believe that was the peak. Here's a 10-year chart. And you can see we've come back. This was almost exactly the halfway point right there. That's a place where short sellers naturally come in. It's called the halfway back. And they entered with force. And so that's been a tough spot, right around 180 for Alibaba Group. You know, they're going to need some big catalyst to overcome that level, and it looks like they've got a bit of a road. It's kind of a show-me story in AI.
Yeah, sounds like it. All right, let's talk about Accenture, too, narrowing its full-year guidance. Now, we, I think, all know some of the at least discussed challenges for some of the Big Four accounting firms, Accenture, being one of them, with AI coming, maybe replacing. I mean, Accenture has also leaned way into AI.
AI is good at slide decks. So
yeah,
watch out.
exactly, and was relatively early to do so. But in the meantime, the company's bookings are just not where the street wants them to be.
Yeah, revenue, so sales 18 billion versus 17.86. Estimated bookings, as you were just talking about, 22.1 billion versus 22.4 billion estimated. So only slight misses there, but still, Bloomberg Intelligence saying the company's anemic new bookings likely reflects tough discretionary IT spending that we will expect to continue amid an uncertain geopolitical climate. Guidance, not that great. Q3 guide was 18.35 to 19 billion. That was below the midpoint of consensus there. Bloomberg Intelligence, again, we don't see any signs of a meaningful recovery for at least the next 2 quarters. And AI is helping, but not enough to kill that disruption fear. So free cash,
Yeah, I mean, that's kind of the key, right? Like I thought the Vital Knowledge quote, the analyst over there, they said it's a decent beat and raise print, but the numbers won't eliminate the existential fear that many have about Accenture being firmly on the list of companies at risk from AI disruption.
Yeah.
So in some cases, like, it doesn't matter what they say, unless there's some kind of big gain from AI or some sort of proof point. And many companies like this, they just don't have that at this point.
Yeah, they got caught up in the AI whack-a-mole, AI scare story as well.
Yeah.
Do we have time for a chart?
Yeah, sure.
All right, let's go to the Wi-Fi Interactive. Here, up 3.75% today. Here's a 6-year chart. You can see kind of is that a twin peak there, Julie? Almost.
It's almost a three-peaker.
Yeah,
I don't know.
three-peak. Chicago Bulls, 1990s all over again. But you take a look at the 1-year chart, down 37%. So, it's a lot of companies that sell information and services have been challenged.
Yes, they have. All right, let's talk about braces, or not actually exactly braces. Invisalign. Align Technology. Activist investor Elliott Management has built a stake in the Invisalign maker. Those shares are up about 4% on that report. The report, by the way, is according to Bloomberg.
And not a lot of details.
Yeah, not a lot of details on what they want from the company, but the shares certainly haven't been doing great.
Yeah, they might be counting on a rebound in the industry, and I do have Barclays was kind of hinting at that. They said the dental markets may be stabilizing, so it could be a strategic time here. But Elliott looks like they're going to be, if not already, one of the company's largest investors. They said they're going to engage with management on different ways to lift the stock price. And this is kind of a classic activist setup. So you got strong brand, category leader, but badly lagging stock. And so Elliott's going to get involved here. Chart it real quick on the Wi-Fi Interactive, up about 4% today. And as I like to do here, we'll go back and we can see this stock peaked in about mid-2021, and it's just been kind of a steady decline ever since.
Yeah, I mean, if you were home during the pandemic, nobody, you might as well.
Yeah, fix your teeth.
Fix your teeth. Why not? All right, Jared, thanks a lot. Appreciate it. Coming up, Disney officially turning the page on its new chapter, how CEO Josh D'Amaro can rebuild investor confidence in the company. We'll share with you a Dear Josh letter next.
4 million people have turned to Self to help make their financial dreams a reality. It's your turn.
All the good times that come from more me time. All the wonder of what the night could bring. All the energy to turn your world around. It's all here, where simply walking in feels like a win. Get away to it all at Choctaw Casino and Resort Durant.
Bad things happen to good people.
Get results. Call Ted Lyon and Associates.
Make a move. I dare you.
With Ring, you can protect your home from anywhere.
When I hear Paralyzed Veterans of America, of course I think of the National Veteran Wheelchair Games, but I also think of policies, advocacy, and legislation, and all of the programs that Paralyzed Veterans of America represent, reaching even more people, helping them understand that life is and can be really good, regardless of the circumstances.
Tello's Ultimate plan just got better than ever. Instead of 35 gigs of high-speed data, you'll get 15 gigabytes more alongside double the hotspot data from 5 to 10 gigs. And if you're an existing customer, they've already upgraded your plan for you. How cool is that? So get connected on America's largest 5G and 4G LTE network by making the switch to Tello today.
New Disney CEO Josh D'Amaro presented his plans for the company at its annual shareholders meeting. He put streaming at the center of the business, calling it the digital centerpiece, Disney Plus, that is. Joining me now, Robert Fishman, MoffettNathanson senior analyst, who wrote a Dear Josh letter to the new CEO with some of your suggestions. I enjoyed your Tomorrowland, not Tomorrowland pun, or from Tomorrowland to Tomorrowland pun for Josh D'Amaro. But I guess let's start at the beginning here, because that's where he started. It all starts with content. What do you think Disney needs to be doing differently?
Well, I think Disney is at a very critical point as we think about the future of the company, given the landscape that they're operating in today. And you mentioned streaming plays a critical role within that Josh D'Amaro called out in his initial memo. But coming back to content, that is where it all starts and where it ends. And that's the flywheel and the magic that Disney brings to this, given the asset mix that it has, where a successful movie can then spur lots of business on the theme parks, consumer products, Disney Plus, and all of the other pieces. So when you think about how important content is to drive this overall flywheel at Disney, that's where it starts. And we are actually very excited about the upcoming slate. So I do think they are on the right path on the content side, and there's a lot of good stuff coming.
Robert, just to dig in on this a little bit, Dana Walden, her president and chief creative officer, seems to have gotten a little bit more power through this transition, even though she didn't get the top job. I mean, their content slate has been okay over the past couple of years, right? In particular, the Pixar stuff has not really been hitting in the same way, except for the more recent one, Better. But it's interesting that they keep the same person there where the content hasn't been as consistent. So do they need to mix that up more? Does she need to think about it differently?
I think you will likely see a change in approach. That doesn't necessarily mean you need to change the people, but I do understand the question. So I do think with this new focus of the company and it is a handoff, right? That this is not like an abrupt change in terms of Bob Iger passing the torch, which, again, has been a very successful era, less so from the stock's perspective. We very much understand that. But the strategic actions that have been put in place to position the company for the future success today, we would argue is very strong given the asset portfolio that they do have and all of the premium IP that comes with it, back to your content point. So when you think about how they can reinvigorate that content slate, again, I think they're doing it now. with the content, it always does take longer to play out. And so this is a couple-year process. And what happened out of COVID and out of the strikes is you continue to get delay after delay. And so you're starting to see the culmination of some of that reinvigorated content starting to come out. You mentioned, the recent Pixar one, Hoppers, and what we think is coming, again, is a pretty strong slate, capped off at the end of this year with the return of Avengers. So we do expect a lot better content slate, or to build on the recent success.
Robert, we'll get to some of the other points, but I do have to address that stock chart, which, as you know, like the numbers underlying the revenue numbers, the earnings numbers, all of that has been fine. The stock price has gone nowhere for 10 years, right? So does all of this change that equation? That's really what needs to, if you're a shareholder in Disney, like that's what needs to happen. What is the thing that makes that stock break out?
So it's a very clear answer to us. I mean, yes, it comes down to content and all of the other pieces around it, but the way that the stock can get unlocked is through the value of streaming. And being the digital centerpiece that was called in the memo, what it takes is to really show Wall Street and all the investor base how they're going to bring all of these different streaming services together and what that can deliver over time. The reason Netflix has been so successful is they gave investors what the dream is, what the story is, and then they executed nearly to perfection. And so when you think about where Disney can go, and we've seen this, from the stock chart, when the stock really broke out, it was the excitement around streaming. So we need to bring back that excitement first and then continue to execute, which they have been doing over the past couple quarters, and continue to build upon that success going forward.
Do they need to spin off ESPN?
I don't know that they need to, but we do think it's something that they should reevaluate and figure out if they can make that transaction work while still being able to use the unique advantage that ESPN does bring to the company, owning and having access to all of these sports rights to play a critical role within this streaming ecosystem. And so that is one of their clearly differentiated assets today, but it has been, looking backwards, an overhang within the stock as the economics of the business has shifted away from linear. ESPN now does have their own over-the-top service, Unlimited, and that was a long time coming. So the fact that that's out there right now allows them to capture some of these cord cutters and cord nevers in a different way. So using ESPN as a unique asset within this larger streaming portfolio is something that we are still kind of waiting to hear how they're going to fully utilize that capabilities.
We'll be very interested to hear about all of that. Robert, thank you so much. Appreciate it.
Thanks for having me.
Coming up, we're going to do our own version of Market Madness for March Madness. We'll explain when we come back.
Jump in my new EV with me. I found it on cars.com.
Since the dawn of time, man has been plagued by itch and irritation from not wiping clean. What man didn't realize is that wetter cleans better. See how Wet Dude Wipes completely clears while Dry TP smears? Ditch the itch and switch to Wet Extra Large Dude Wipes for the best clean, pants down.
Save on all your Lone Star favorites during Spex's Texas sale. From the plains to the pines, you'll find the largest selection of Texas-made spirits, wines, beers, and seltzers right here at Spex. Cheers to savings.
Worried about parents in India? Explore Vardhan Senior Living Delhi. Call now.
Life is more legal than you think, and LegalZoom is here to help. Whether it's registering a business, starting a will or trust, or staying on top of your business licenses. When you need a legal hand, turn to LegalZoom.
Yahoo Finance has started our own competition for March Madness. We're calling it Market Madness, where we're pitting 32 companies against each other in a tournament bracket. Who wins, you ask? We're letting our guests decide. Stock pickers. Adam Coons is joining us now. Winthrop Capital Chief Investment Officer, joining you now for Market Madness, brought to you by Everpure. Our first contestant, I guess, is what we're calling it. Our first matchups that we're taking a look at today. Adam, thanks for playing. So we're going to run through these pretty quickly, and then we're going to kind of zero in on a few of them. So I believe we're taking the right side of this bracket first here. So I'm going to take it, I think, from the top bottom here, and then we'll dig into a couple of them. So first on the matchup, we've got JP Morgan Chase and TJX, the retailer. Which one of these would be your pick?
Yeah, here I'm picking JP Morgan. I think just deregulation is on the horizon. I think we've got some news today, so I think that's really the propellant here for large banks.
All right, we're going to come back to JP Morgan in a minute, but let's get straight to the next one. Boeing and Netflix. This is an interesting one.
It really is. But right here, I think you got to pick Netflix. They're going to emerge from this kind of bust of a merger acquisition, and I think they just have more that they can do with their cash flow. Boeing just keeps screwing everything up.
Gotcha. So not a lot of optimism for the upside there. ExxonMobil and Amazon. As we know, ExxonMobil's been having quite a year so far, but where do you think they both go from here?
Yeah, and that's the reason why I picked Amazon over them. I think you've kind of seen the most you're going to get out of increased oil prices being priced into Exxon. So there's probably more downside than upside there. So Amazon, a lot of different stories you can play into there that makes it the winner for me.
Okay. Next up, we have Delta and Apple.
Another interesting pair up here. I think Apple is just one of those companies where it's kind of hit a wall. Having to use Google for their AI, it kind of tells the story there. So for Delta, I think you're looking at more business travel. The consumer remains very resilient, so travel is going to maintain. So that's why I picked Delta.
Okay, that's an interesting one. NVIDIA and Paramount.
Yeah, you got the behemoth here, NVIDIA.
Yeah.
I think, look, Paramount and Warner Brothers, I think you've got two sinking ships. Just because you tie them together doesn't make anything any better. So here, that's why you're going to pick NVIDIA, just sticking with the classic AI story here. I think there's still more upside for them.
All right. Next up, we were just talking about Walt Disney and the new CEO, Josh D'Amaro. They're getting matched up against Mickey D's McDonald's here. Who do you like?
Yeah, so this is a tough one. I think, if you look at what can kind of be the upside story, it would be Disney. I think it has more upside potential, but there's just a lot of execution risk. So I think, to play it safe here in the bracket, I'm going to go with McDonald's. It's tried and true, kind of can stay the course through an economic downturn if we see that.
Okay. Next, we've got Microsoft and Coinbase.
Yeah, so this is what I'm calling my Cinderella story in the bracket. Obviously, Microsoft, again, similar to NVIDIA, is the behemoth in the AI story. But I think being tied to OpenAI is going to hurt them. And so, again, I think it's a tough one. This is kind of the outlier. But I think Coinbase, it's obviously highly levered to the crypto, which is very volatile. But I think if you're going to pick a Cinderella story in the bracket, this is it.
Oh, interesting. Okay. And then finally, and as I mentioned, we're going to go back to a couple of these. Finally, Ford and Nike.
Yeah, a couple of American brands are just really struggling. I think the reality here is that Ford has more downside, just having a hard time executing on the EV story. Nike obviously has a lot of headwinds, but it's a really strong brand. I think that they can make a comeback here, so that's why I like Nike.
All right, as promised, I want to come back on a couple of these and sort of double click, if you will. First of all, JP Morgan, you mentioned the deregulatory situation. I mean, we got to say also, all the financials have not been doing well this year. There's been concerns about private credit, right? There's the rate outlook for cuts to rates being pushed out. So what do you think turns things around here?
Well, I think it's just that I think you've kind of overblown several different stories in the market when it comes to banks and their exposure, especially someone like JP Morgan. Similar to some of the kind of software sell-off, what you're seeing in banks is that they're all being kind of thrown out here. But JP Morgan is fairly, fenced off from private credit. massively, unlike a bank like Jefferies that's highly levered to private credit. So I think that they're removed from that. I think the risk of interest rates coming down significantly, I think, is a little bit overblown. Actually, after yesterday's meeting, you saw the probability of rate cuts in the futures curves move to 0% that we're going to see any more cuts this year. So I think the market's starting to rethink that. And then, like I said, the bigger story here is you're going to see more M&A activity. Just broadly, but also in the banking sector, as you obviously there's been some distractions of some sort from the Trump administration, but one of the platforms they ran on was deregulation, and we do think that's on the horizon. Like I said, we got a little bit of news on that today, and so I think those things unlock earnings potential for JP Morgan. So that's just why we like it right now.
All right, let's. And the other one we want to double click on is McDonald's. Those shares are okay year to date. They're up about 2.5% here. So what do you think? Why does that look good to you?
Yeah, as I said at the beginning, this would be more of a safety play, more defensive. McDonald's is obviously, and just different kind of economic volatility regimes can outperform because it's just stickier revenue. They've struggled outside of the U.S. lately, but overall, we think that it is kind of that tried and true type name. And so that's why we're picking it here. It definitely is the safer way to go. I think that there's just too many unknowns when it comes to Disney. I think it's, obviously a great brand, a great platform, but they've just had too many missteps lately. And so I think that they can get it turned around. But like I said, there's a lot of execution risk there. Yeah. So Disney definitely has more upside potential than McDonald's, but it also has a lot more downside potential. So that's why we went with the safe play McDonald's.
And you're okay with the way Chris Kempczinski eats a burger, I guess?
You can't escape that,
No, I guess
every
we can.
CEO seems to make these little faults, but
All press is good press, maybe. All right, Adam, thank you so much for playing. Really appreciate it. And you can stay tuned. We'll have more Market Madness. We got to go through the rest of the bracket. We're going to look into the other side of the bracket. That's coming up Friday on Market Domination. That does it for me and for Market Catalyst. Thanks for watching. More Yahoo Finance is coming your way.
TaxAct doesn't care which tax filing software you've used in the past. Let's get them over with.
Welcome to We Are Augusta, the Women's Financial Forum podcast presented by Trajan Wealth.
I had one person who was loyal to me, sorry. And you asked for the help. That's hard.
All the good times that come from more me time.
It's time for Yahoo Finance's Market Minute. I'm John Hyland. I want to kick things off today with mortgage rates. We just got the latest data from Freddie Mac that showed the average fixed-year 30 rate actually jumped 11 basis points this week to 6.22%. That, of course, adding more pressure to the housing market, and it comes as the Fed has to grapple with its inflation problem. If you flip up the board, you'll see that the metals market's under pressure today. Traders are rethinking the outlook for rate hikes this year, or for rate cuts, I should say, potentially hedging for 2027 for a rate hike. So what does stricter monetary policy mean? It means gold below $5,000 an ounce. You're seeing that today. There were earlier calls this year to see gold at 6,300, but that might not be happening. And then just flipping the board up, we are seeing risk assets under pressure today as well. Bitcoin falling below that $70,000 mark. Yesterday, it had its worst day in 3 weeks, and we're seeing the war in Iran continue to weigh on broader markets as a whole. I'm John Hyland, and that is your Yahoo Finance Market Minute.
Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Jared Blickery, your host, and with me is my co-host, Yahoo Finance senior reporter Brooke DePalma, who's here to connect the dots and to be that bridge between Wall Street and Main Street. Today, we're honing in on the job market, but also keeping a focus on markets as well. Our phrase of the day, jobless expansion. We dig into the uncomfortable reality of the collapse in job growth while the economy keeps humming along. Critically, is this the new norm for 2026? And for today's market show and tell, we're going to look under the hood at market breadth, specifically how many S&P 500 stocks are actually trading above their 200-day moving average, and why this is important to the current bull market. And this episode is brought to you by the number 20.1. That's the so-called forward PE ratio for the energy sector, which is at a 5-year high. We compare it to the tech sector, which is falling like a stone. What this is saying about sector rotation. And to help us make sense of it all, we are joined once again by Kevin Gordon, who's head of macro research and strategy at the Schwab Center for Financial Research, and one of the best in the business at turning big macro signals into practical market frameworks. He's also a lifelong musician, playing 7 instruments, and a serious home chef. But before we really dig into the jobs numbers here, just tell us what you think of this rally of the economy as we, I guess we're about 1/3 of the way through February.
Yeah, it feels like we're still in January. I think
it feels like a lot of different things.
A lot
of things have happened so far.
I've been making that joke lately, but it does feel like we're in January. No, I mean, I think the flavor of the rally over the past several months, well advertised at this point, but really moving away, as you mentioned, from that tech leadership or the tech adjacent leadership and going into other parts of the market. I think it's been really interesting and an interesting thought experiment for a lot of investors who have been used to so much of that mega cap dominance over the past several years, where now you are still seeing healthy breadth, but it's not necessarily materializing and manifesting in strong index level gains. And that's just, I call it just the math. Right. The math of the index, of a cap weighted index like the S&P 500. If you can sort of dish it out in terms of the growth in those sectors over time and how much they account for the S&P, you have to be able to take it when they're not participating as much and when you have tech as the worst performing sector over the past month. So I think it's still a relatively healthy backdrop. It's just very different than what we've been used to in terms of seeing a lot of these really strong cap-weighted index level gains.
Yeah, and we also did get some new jobs data out, which is time now for our phrase of the day, and that is jobless expansion. And it sounds like a contradiction, but it's pretty simple. The economy can keep growing even as job growth cools way down. And today's job data is a perfect example of why this is confusing. On one hand, the 3-month average of payroll gains just ticked up to about 73,000 in January, a 1-year high, as Kevin points out on the X platform. Now, on the other hand, the big annual benchmark update is saying, careful, 2025 payroll gains were revised down to about 181,000 when they were over 7 million in 2021. So the main point, job growth is positive, but down big. Meanwhile, growth is strong here. So, Kevin, what does a jobless expansion mean for both workers and investors?
So, well, I think the first thing I would say is that this is not terribly unique relative to history in the sense that we have seen it before. The last time that we saw it was in the early 2000s.
Yeah,
so
the
after,
big housing, jobless recovery. Yep.
Exactly.
Now, early 2000s, though, are we spooked by that, guys?
Well, no, I mean, it's interesting because I say it's a unique kind of data point because you had the recession in 2001, but the unemployment rate kept rising actually well into 2003. And when you look at payroll growth and the expansion that started at the end of 2001, it was pretty weak. I mean, you really just had only GDP expansion without this movement in the labor market. So in some ways, it's apples to apples. In some ways, it's not, because you could look at that period and say, well, we were exiting recession. Right now, it's hard to argue that we're exiting recession, with the caveat that the 2001 recession was actually pretty mild. So in GDP drawdown terms, it really wasn't that bad. So I think that, it's unique to see relative to history. Of course, we don't want to be in a jobless expansion, but I think given where we are right now, aging demographics, a lot of downward pressure on labor force growth because of, almost no net new migration. We'll see what the updated numbers are officially for 25. But when you combine all of that, it just means that your so-called break-even payroll rate is much lower. So the amount of jobs that you need to create, that our economy needs to create each month without having to see the unemployment rate move materially is just much lower. We sort of learned that, in this most recent slate of jobs data for January. We had a really significant beat to the upside for payroll growth.
Right.
And the unemployment rate moved down to 4.3%.
When economists forecasted, I believe, 4.4%.
Yeah, exactly. So I think that, from the point of view of the worker, the average worker, it is a worrisome sign, especially if you're one of those individuals who doesn't have a job. But at the same time, in terms of the overall stock of payrolls, because there's an important stock versus flow discussion that you need to have when you talk about payrolls, the overall stock is still at an all-time high. So when you talk about, month to month, how many people are employed, how many people are making money, able to put that money into the economy, it's still at an all-time high. So that growth engine for the consumer is still going. It's just that flow is now, considerably weaker. Maybe it's turning higher a little bit, evidenced by January jobs data. But that, I think, is the really important distinction to make, is that because of the nature of demographics and where immigration is right now, you're just having a slower sort of speed limit or a slower rate that you can go at in terms of job creation.
Yeah, stock versus flow.
The job backdrop is, if you look at the net percentage of industries that are hiring, now it has, firmly crossed into positive territory. It's been there for a while. It's at 55%. That's the so-called employment diffusion index. So just the share of industries on a net basis that are hiring. So that is stronger. But when you look at the composition of it, it's health and education services that are dominating that. And especially for 2025, that was the sector basically that was adding all of payrolls. If you took that out, you kind of had nothing, essentially, on a year-to-year basis. I think that, admittedly, I had a feeling coming into 26 and the data that we were looking at, that you were probably going to see some sort of stabilization in unemployment by the middle of the year, and maybe an eventual rolling over, because a lot of the CapEx data that we've seen in the business spending data and just the strength of that historically does lead to stronger employment data. So I think it's maybe being pulled forward a little bit. So we didn't expect it to happen as soon as it's happening now. If you did in fact see the peak in the unemployment rate being in November, that is a pretty material, I think, move and shift for the economy. But what that means for hiring, I'm not so sure it's going to be as robust as it has been in prior expansions. I just think back to the labor force point, there's just not as much for us to draw from. And I think a lot of companies have still been spooked by, number one, what happened with tariffs last year, still adjusting to that. But number two, being able to figure out if they can continue to grow their businesses without having to hire a lot. And you've heard certain anecdotes about this in the media and the news over the past, several months. But to the extent now that AI becomes a little bit of a bigger player in that, not having to hire as many people, especially at the entry level, I think that's going to be a really big focus for this year. So to me, I think about it a lot in stabilization terms. Whether it is this firm reacceleration, I think it's a little bit of a different story, especially when you compare it to prior cycles, and the fact that we didn't go through a traditional recession, in the past year.
Got a lot to figure out here.
Yeah.
Let's talk markets. markets, and because it is now time for market show and tell, and today we're looking past the headline index number and into market breadth, which is a way to judge how widespread a market move is by counting how many stocks are participating. We've covered this before, and there are lots of ways to do this, because here's the main thing. The S&P 500 can look like it's going nowhere, even when a lot of stocks are quietly getting healthier. Some might be getting not healthier. So we're going to look at market breadth through this lens. How many S&P 500 stocks are trading above their 200-day moving average? The 200-day is just a long-term average of prices that shows the current trend. And when more stocks get above it, that's a sign that the rally is spreading out, not just riding on a few big names as we've seen in the past. So Kevin, when you look at this breadth measure, what does it tell you right now about how healthy this market really is, even if the index is feeling a bit choppy?
Yeah, so overall, still relatively healthy. If you looked at the whole universe of stocks in the NYSE universe, which is, I call it the market, then that's right at 2/3 as of yesterday's close. So you're at a pretty healthy territory and sort of atmosphere. But even over the past several months, that percentage has actually been grinding higher, a little slowly, but it's been grinding higher. Even as you've had a lot of this carnage in certain sectors like tech, and that's depressed the index level gains. But even for something like the S&P 500, you've been kind of hovering right around closer to 70% on average lately. And I think what's been a little bit more remarkable has been the catch up in that statistic for the Russell 2000. Small caps.
The catch up. Yeah, let's talk about small caps.
Doldrums. Yeah, I mean they've been so weak for so long in this bull market that we've been in since 2022. Sort of had these historic years in a negative sense for small cap participation or lack thereof in 2023 and then 2024. So we've been waiting for so long for them to really get up and going. And I think that for many reasons, strong fundamental reasons, they really have started to turn higher now, and they've really started to catch up. And one of the metrics that confirms that is that breadth statistic that you mentioned.
And just really quickly on software stocks, will we see a rebound here?
Well, the easy answer.
Do you have a fear of them being obsolete?
The short answer is I don't know, and nobody does. I think that for a sector like tech, because that's where software lives, within. A lot of the questions have been around how much of this is an earnings-driven move versus how much of it is just multiple compression. Right. So far, it's just been the compression in valuation and multiples, and I think a lot of sort of de-risking, whether it was tied to any leverage or not within that space in particular, but I think just a lot of de-risking and sort of that knee-jerk reaction when you have everything around, the AI narrative that was sort of pushing a lot of those
Remind
moves.
me of DeepSeek last year.
Exactly.
It was a catalyst. And stuff happened.
Yeah, and I think, it's sort of that one area when you look at significant gains relative to the S&P over several years, it was that area that was quite extended. It was that industry that was quite extended. So to the extent that investors wanted to take profits in a certain area, deploy it elsewhere, whether it was energy or materials, which had been leading, I think that makes a lot of sense. So to me, if I was specifically looking at that industry, which we don't get down to that granular of a level, but I would look at the earnings profile of the industry and a lot of the companies if it hasn't changed materially, which for tech as a sector, it has not changed materially this year. Mm-hmm. So I think that's still a relatively fundamental underpinning, but it gets to the fact that when you're talking about sector leadership, especially in an earnings sense, it's the differentials and the growth rates that matters more than anything else. And I think that's been the bigger story actually since last earnings season, not this current one. The turn for a lot of this outperformance in terms of equal weighted S&P or small caps, it was around the end of Q3 going into Q4 when we had earnings season for the third quarter, right, when you started to see a lot of these estimates really move higher for the rest of the market. And so I think that has been, again, to the whole point about differentials and rate of change mattering more for earnings for a lot of these sectors, I think that's been to the benefit of them.
Right, we do need to take a short break, but coming up, we're talking energy versus tech and a symphonic runway battle that's music to investors' ears. Stay tuned.
Build storage your way. U.S. General, only at Harbor Freight.
Welcome to We Are Augusta, the Women's Financial Forum podcast presented by Trajan Wealth.
I had one person who was loyal to me, sorry. And you asked for the help. That's hard.
The reality again is I just think this 3% inflation makes a lot of sense, not 2%. I love what you said there about the Fed. They're not going to come out and say it, but I think they understand. And again, look back in history, everybody. What we just went through for 15 years during the ZERP period, 2% inflation really isn't that normal. What happens with that? We have low yields. You don't get anything for cash. There's some negatives to that. So 3%, we're good with it. We're good with 3% inflation.
I agree with you. I think 3%. I think people just have to. They're going to have to just get used to that, because they were conditioned to think it's 2. The Fed's going to go to 2. We're not going to do anything to get to 2. We're not getting to 2. We're just not getting there. We'll get close, but we're not getting to 2. And so that's why I think right where we are, 2.83% is actually okay. Okay, so let's talk about concentration myth. There are 500 names in the S&P 500. There are 7 of them are MAG, right? The MAG 7 names. But there are 493 other names that are in the S&P 500. So I think you and I are very much on the same page about this. But go ahead, talk about the myth.
Yeah, so great question. So we've heard for years there's only 7 stocks going up. Now I think that's kind of gone out a little bit. I think because people are realizing literally like last week the S&P 500 equal weight hit an all-time high. So again, yes, on market cap weight in 23 and 24, if you didn't have a big allocation to large cap tech, we underperformed your benchmark, you underperformed your peers, you underperformed everybody. But what we're seeing now clearly is more of a broadening out theme. And we look at like the S&P 500 last year gained right about 19% on a total return basis. Last year was the first year in 4 years where the 493 actually contributed more to that gain than the MAG 7. Yeah, the MAG 7 a couple years before obviously contributed more. And I think these are some important things. The other thing that I think is neat, we looked at 25 of the largest developed countries and looked at their ETFs, right? And we looked at the 10 components. How much of the 10 components of their overall stock market? Well, U.S. is 39%. We've heard this for a while. The top 10 are 40%. The media tell you that like it's bad. I'm not saying it's bad or good. I'm just saying then you look at the data, Kenny, that is actually one of the lowest top 10 concentrations out of all of them. I think it's India and Japan are lower than us. So obviously it's less than 39%, wherever that is. But most developed countries around the globe, their 10 largest companies attribute more. And I get it. It's because of small-ish countries in Europe. They've got a couple big companies. That's why. But listen, if we're saying the U.S. is so top-heavy, I'm looking around the globe. We're not as top-heavy as other places. That's busting some myths that are out there from that only 7 stocks, and we're top-heavy, in my opinion.
Yeah, no, and I agree with you. And I think we are, and we made this point at the very beginning. If you look at what's happening, there are certainly other areas of the market that are excelling. SMIDs for sure, and SMIDs are typically not part of the MAG 7. So you got to look beyond just the 7 names. I'm not saying get rid of the 7 names, not at all. I'm just saying there are, like you, that there are other opportunities.
Right.
Okay, so
Agreed.
talk to us about your bull market cycle theory about that in your opinion we're still in kind of the younger stages of this bull market and that there's a longer runway ahead of us.
Yeah, when I say this, it sometimes surprises people, but this bull market turned 3 last October. Remember October, I forget when it was, October 12th or 13th of 2022, vicious bear market, and market's been rallying ever since. So we're in the 4th year of this bull market. Kenny, we went back 50 years. We found 5 other bull markets that made it into their 4th year. There were some that were shorter, but they kind of, flamed out fast. But once you get extended like this, get moving, I say bull markets are like a cruise ship. Once they get moving, they're hard to slow down, they're hard to stop, they're really hard to turn around. Well, looking at those other 5 bull markets that made it to this point, the last 50 years, the average length was 8 years before they actually peaked. The shortest was 5, and then we had 2 that went double digits. I have no idea how long this was going to go, but I guess what we're really trying to stress is this bull market is likely much younger than most people think. And then you want to get real wild with it. I mean, small caps just now are breaking out to levels they were trading at 4 years ago, right? Energy stocks were literally at the level they were trading at 17 or 18 years ago. How about Germany? Germany just last year, and Europe for this matter, the German DAX just broke out above levels early last year. It was trading at in 2007, 2008. So I'm talking about the U.S., yes, but we can look at other parts of the globe, and you could argue, and I am, that some of these bull markets are really, really young, and those are some areas you want to have. Last comment on this, we manage real money. We've been overweight equities a while. Yes, we have a globally diversified portfolio. We like the U.S., we like developed international, don't like EM quite as much. We don't really trust China. But again, for a portfolio point of view, you want to own a lot of these other areas. We don't think last year was a one-off. We think this outperformance from the rest of the globe, or at least keeping up with the U.S. from the rest of the globe point of view, is probably here to stay for several years.
Yeah. Listen, Ryan, I could talk to you about this all day. Today, I'm going to give you pasta fagioli. Now, pasta fagioli dates back to ancient Italy, when beans were the primary source of protein long before meat was even affordable. Early versions were essentially bean stews sticking with whatever grain or pasta was on hand. As dried pasta became more common in the Middle Ages, the dish evolved into this comforting marriage that we now know as pasta and beans, olive oil, aromatics, and a tomato sauce, right? Now, there was never one recipe. In northern Italy, it might be lighter. Sometimes it's going to be a different bean. Sometimes it's with a touch of pancetta. In the south, it's heartier. Garlic, tomatoes, rosemary, maybe even the rind of the Parmigiano or the Pecorino Romano that simmers slow in the sauce. Listen, I made this yesterday in the middle of this snowstorm, and I made it the southern Italian way, but I put the pancetta in there. Oh, my God, it's so good. But when the Italian immigrants came to America in the late 19th and early 20th centuries, pasta fagioli came with them. Why? Because it was cheap, it was filling, and it was endlessly adaptable, earning its place as a staple in the Italian-American comfort food. At its core, it's not fancy, and that's the point. Proof that simple ingredients, treated with respect, just like your portfolio, can be unforgettable. Now, you can scan the QR code on the screen for the full recipe, and trust me, you will thank me later. That's a wrap for today's Trader Talk, but the conversation continues. Subscribe on Apple Podcasts, Spotify, Amazon Music, or wherever you get your podcasts. If you got questions or topics you want covered, email me at tradertalk@yahooinc.com, because we're always listening. Until the next time, stay sharp, stay disciplined, and stay in touch. Take good care.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.
University of Phoenix is built for real life. At some schools, to save money, you have to move fast and load up on courses. We keep it simple. Take one course at a time with fixed, affordable tuition. Get started at phoenix.edu.
Texans know for selection and lower prices, it all starts at Specs. No matter what's on the menu, we've got you covered. With all your favorites on tap, you'll bring home the win. Special occasion? Flirt responsibly. Boots on, drinks up. The fun starts here.
Shop Specs, low priced, amazing. Here's to you. Cheers to savings.
All the good times that come from more me time. All the wonder of what the night could bring. All the energy to turn your world around. It's all here, where simply walking in feels like a win. Get away to it all at Choctaw Casino and Resort Durant.
I got a guy, and he is the best sales associate that I've ever had. And he does everything. I call him for everything. Friend that wants to buy a BMW, I call Xander. My kids need another car, I call Xander. It's not just somebody selling you a car. This is somebody who is building a relationship that will last forever. It's wonderful to have a relationship like that.
Experience the Sewell difference for yourself today at Sewell BMW in Grapevine or Plano.
The power of Paralyzed Veterans of America can be felt everywhere. For over 80 years, PVA has been a relentless ally for veterans with spinal cord injuries and diseases like MS and ALS, and all people with disabilities, empowering them with the support they need to build the futures they deserve, so they can gain the freedom and independence to thrive. That's the power of PVA.
Retinal vision only on Ring. AI tuning for sharper goodbyes, clearer hellos, and safer tomorrows. Protect your home like I do with Retinal Vision on new 4K cameras and doorbells from Ring. Shop now at ring.com.
Think of all the places that could expose you to identity theft.
If something happens, LifeLock provides a U.S.-based restoration specialist to fix it start to finish, guaranteed or your money back. Don't face identity theft alone. Join LifeLock today.
It's time for Yahoo Finance's Market Minute. U.S. stocks continue to slide here on Thursday as oil prices spike. Strikes on key Middle East energy hubs stoking already intense inflation concerns on Wall Street. As comes expectations for interest rate cuts dampen, even as the Fed signals one cut could still be on the table this year. Sticking with the Fed, the central bank unveiling its proposal for lower bank capital requirements. This move would reduce banks' cash cushions to align with changes in the economy. Under the proposal, the largest banks like J.P. Morgan Chase and Bank of America would see capital fall on net by 4.8%. And lastly, Five Below shares surging after a great holiday quarter. The off-price retail chain reporting same-store sales growth of 15.4%. Company, however, coming off more cautious about its full-year financial guidance. Five Below citing tough comparisons in the quarters ahead. And that's your Yahoo Finance Market Minute.
Welcome to a new episode of Opening Bid Unfiltered. I'm Yahoo Finance Executive Editor Brian Sozzi. Let's get right into it here. I want to welcome on for my special guest here for this episode, Dr. Songyi Yoon, founder and managing partner of Principal Venture Partners. She's also on the board of HP, a company that I've known for many years, and I've known a lot of executives over there. Songyi, so great to see you. Thanks for stopping by to do this. This is quite a moment in AI. It's so amazing. The technology is moving at such a fast pace, yet in my world of stocks and markets, the stocks aren't doing well. I'm just curious to get this started. Your assessment on this moment in AI, where are things?
First of all, thank you so much for having me today. It's a really, it is great to see you here. As a person who's been studying AI for decades, I think this is a really tremendous moment. I think technology moves. One of my favorite quote is that the future is already here. It's not just evenly distributed yet. I have seen that over the last decades. A lot of the technology that we're talking about, like whether it's agents, swarm intelligence, like the synthetic data generation, and and word models, etc. Those are the new concept. That those concepts themselves and ideas have been around for many decades in different type of publications and research labs, etc. This is tremendous now because now finally it's in the hands of a lot of people. A lot of people gets it. The capital is behind it. There's a lot of compute, data, and talent. So it's becoming a reality, and I think that makes this moment so special. However, I think it's just like any other platform shift moment in the past. I think it's really, we are at the very early inning of this, the kind of newest platform shift. We're still building infrastructure. We're still trying to figure out what is the right operating system for the coming decades. And so I think there is a lot of optimism and sparkle of imagination. But I think that we have to also go in with a level of caution.
How does I still remember when I started to hear about AI agents. I think it was from Salesforce co-founder and CEO Mark Benioff. It was 2 years ago. I didn't even know what he was talking about at all. Now, obviously, I do. And now we're starting to see these AI agents permeate very large companies at a very rapid pace. And what is the evolution? I'm trying to figure out what is next on the AI agent front. How might these agents look different a year from now, 2 years from now than today?
I think I don't have a crystal ball. I don't know exactly what's going to happen in 2 years. Agent is a very interesting architecture. Like it allows them autonomous kind of action taking by all this artificial creatures in our system. So I think it really helps with the automating processes. There's a lot of I mean, but the agent themselves is kind of it's a limited amount of the information they're taking, and also like the processing power. There is also I think there are many different ways to take it. Like for example, we talk a lot about physical intelligence. A lot of agents could be living in the like last miles and physical devices that we deal with, and I think that could be one avenue to go. Another thing is the concept of swarm intelligence, like what one agent can may not be robust enough. There could be tens and thousands and tens of thousands of agents collaborating to come up with solve problems together that could give more robust and reliable answers. And that's a way of like also implementing intelligence. So I think it's really hard to say in one sentence what an agent will look like in a couple of years. But I think there are many ways to how it can evolve and how it can be more deeply integrated in everything we do.
What did you think about that? What is it? Citrini research report.
I mean, I think it kind of rattled the internet. It was an interesting prediction. But I think it's what really matters is not just about how the technology is going to evolve in its own, but I think this is a moment that participation of all of us is needed. I think technology is interesting. It's fascinating. I think it captures attention of a lot of us, but the question of the resource allocation or prioritization, where our kind of resource and energy is going to be deployed, has been prioritized and deliberated through a democratic process and participation of all of us who are the consumers, taxpayers, and the users and investors. So I think it's a very important moment because a lot's happening at such a kind of unprecedented pace. Instead of just kind of standing at like a sideline, just watching what's happening, we should be able to participate and shape the future in a way that we'd like to live in.
I recently caught up with Block's CFO, and we were discussing a lot about, they laid off 40% of their workforce. There's 4,000 human beings now that don't have any more jobs, and they are really leaning into AI and various other technologies, and they're not alone. They're not alone. I imagine it's going to get worse. Is it, some of the worst case scenarios that Citrini put forth? I mean, is that even possible? What's the possibility on something like that happening and unemployment spiking and people out of their jobs? It's just so dystopian.
Yeah, I mean, I think it's a lot happening. I mean, I think it is true. Like some of the processes and the work that we've been doing in a traditional manner has been becoming more. It becomes more efficient, and it requires a lot less kind of involvement of certain type of labor as we did in the past. I think it's that kind of transition happens every time that there was a kind of new GPT, like not ChatGPT, like general purpose technology was introduced, and there was a shift in platform. Imagine like what NASA looked like decades ago. We didn't have small computers. We didn't have the processing power that we have on our fingertip. It was like tens and hundreds of people doing very complex calculations together surrounding supercomputers. That has been all shrinked. We are not saying that it was a kind of the technology evolution, and those talent are doing working on other problems, solving other performing other frontier research. I think it's not like the world is short of problems to solve. I think we are finding ways to solve problems in a more efficient way. And I think there'll be a lot of interesting new jobs and new the areas that needs the level of human attention and talent and intelligence. However, I think this transition is not easy. It doesn't happen automatically. And as a society, we have to really pay attention how we can upskill the workforce, how we can provide opportunity for them to be trained and get ready to take a new challenge. And I think those are the things that we have to be very conscious of and make ample attention and investment.
What role should government play in helping to retrain the country's workforce? Because I had one CEO remark to me the other day and said, Brian, you're no longer very soon going to be managing human beings. You are going to manage agents. And I looked at them, I'm like, wow. I mean, it was just a lot for me to take. Maybe I'm just a manager of 500 agents and not even a single person.
Yeah, that's right. Yeah, I mean, I see a lot of interesting startups these days. They come to me and like pitch their business plan, and I ask, how many people do you have? And what is the kind of full-time equivalent? And they say, oh, we have 2 people and like 16 agents.
That's the business model of the future. It's 2 humans and hundreds of agents. I mean, that's quite the potential ROI, right? That's a hell of an investment.
Yeah, right, yeah. I mean, I think it's a role of government is very important here. I mean, I think as you mentioned, like education is that has been traditionally, but the role of government can set the agenda, how we can provide a safety net for those who are like slower, can be slower and who needs more support, so that we all can benefit from the advancement of this technology. And I think that will be very, very critical. And also we have to think about what the future of education should be like too. If you look at the education today, it has been optimized for delivering knowledge. And knowledge is becoming commoditized to a certain extent because we have this kind of search, we have agent at our fingertip, memorizing and just kind of having the knowledge delivered the most efficient way may not be the most important role of the education. I think it's all about fostering creativity that's going to be more important, and problem-solving skills and how to adapt to the new environment are the skills that's needed and need to be educated. And what is education? What is a classroom should look like? How we should set the curriculum so that the kind of the workforce of the future is ready, get ready for that type of environment is something that we have to think about, cannot be complacent.
What are the type of questions that board members at public companies should be asking as pertains to AI?
I mean, I think it's I think similar to that's the topics we're touching today, right? I mean, I think how the companies themselves have to evolve with the evolution of technology and also expectation of our customers. Our customers expecting for us to deliver at embracing and utilizing the kind of best technology exists in terms of the productivity, in terms of the kind of performance of the product and services they will deliver and the way it's delivered. And I think company has to be ready to make that transition and evolution at the pace that the market expects. And I think in the boardroom, I think we have to ask the type of questions. Are we ready to go through that transition? Is our workforce prepared to kind of to make that transition and have them educated and upskilled to deliver that type of new type of service and product to the customers and consumers of.
The genie is out of the bottle, and it lives in DataBox.
All the good times that come from more me time. All the wonder of what the night could bring. All the energy to turn your world around. It's all here, where simply walking in feels like a win. Get away to it all at Choctaw Casino and Resort Durant.
We gon' get it done. We gon' get it done. We gon' get it done.
Same address, whole new vibe. Power, our work shows.
How to find the right car for you. Go to cars.com. Look at the car you like.
Ciao.
Ciao. Find your next possibility on cars.com.
Welcome to Perk, the intelligent platform for travel, events, and spend.
I'm Jamie, founder of Ring. Our latest invention, Retinal Vision. AI tuning delivers ultimate clarity for unmatched security. Protect your home like I do with Retinal Vision on new 4K cameras and doorbells from Ring. Shop now at ring.com.
Life is more legal than you think, and LegalZoom is here to help. Whether it's registering a business, starting a will or trust, staying on top of your business licenses, or talking to an attorney to make sure it's done right.
I'm a LegalZoom network attorney. I hear you have a landlord issue.
When you need a legal hand, turn to LegalZoom.
It's been hard for me to wrap my head around the view that companies that are earning tens of billions of dollars are no longer going to exist maybe in 5 years. Like I just can't conceptualize that. I mean, is that even something you have thought about?
I think that's a really good question. I'm not a stock market investor, so I think I'm sure that there are a lot of psychology and a market prediction that go into it. I think there are many different forces that go into it. People often say the average lifespan of Fortune 500 companies is 11 years. And I think if you look at the statistics, it's about 23, 25 years. What that means is that there's always kind of new entrants that come up with more efficient and more economic solution. And there's always market disruption. So I think that we have to take a look at it in a way that it's not as a surprise. It's kind of that has been like that over the as long as the kind of the capital market has been around. So there's always a disruptors, and when there's a technology and data and a kind of some kind of ingenuity comes into market, that happens. So I don't think there's nothing that's permanent, whether it's SaaS, whether it's software, whether it's in any other areas. Yes, and also it's true that the recent development of AI and technology makes some of the tasks that was done in a traditional way in a more efficient way, and it's seemingly the market that look like there is no other competition becomes a very competitive marketplace. So you don't have that same type of pricing power. You don't have the same type of the bargain. So I think it's we just kind of accept that there's always that disruption. There's a new entrance, so you have to kind of keep moving forward and evolve to really defend the market that you have.
But history, I would imagine, also shows that large companies can reinvent themselves. This view that ServiceNow, for example, I'm just calling them out. They're just top of mind. I was checking out their stock price a couple minutes ago. But they can't reinvent themselves. Of course they can reinvent themselves. And of course they're playing in AI.
Yes, right, exactly. Yeah, I look at Disney. Disney has been it's a great one of the great companies. And how many times I cannot even count how many times it successfully reinvented itself as an internet era, mobile era, and an AI era. So I think it's possible. It's not easy. So some of the companies will succeed, some of the companies won't, and that has been always the case.
How important is a potential OpenAI IPO later this year just to validate the AI ecosystem? Does the AI ecosystem even need that validation by an OpenAI IPO should it happen?
OpenAI IPO, I think it's another very exciting moment given the kind of the type amount of valuation that it's commanding. I think it's hard to tell. It's a way to. I think it's for sure the type of AI that they're developing requires a lot of capital investment and expenditure, and I think now the technology and service is more understandable to the general public, and not just kind of a very small handful of investors. So there might be. I think it's possible there could be. Retail investors who will be interested in supporting and investing in those companies and make it more accessible to the capital that they need to continue to sustain in this market. And I think it's a very strategic decision by different companies. And I think I don't think there is one right or answer to all this. I mean, some companies may decide it's a best path forward for their future, and some companies may not. And I think that there is a truth to all of those choices, and I respect individual choices of the companies.
Does one model ultimately win? Does OpenAI and ChatGPT just take the cake, or are we looking at a Coca-Cola and PepsiCo situation where multiple models could exist and everybody does well?
I think that really is like $1 billion question here, right? I mean, I don't know. I don't even know where to start because it's a very nuanced question, and it can one can answer in many different ways, right? It's one of the long-lasting questions in the field of AI has been always like that, like a general model versus a special model. Who is in a better position to perform, to do certain things? If we know exactly what is a problem that we're solving, what is a finest space of the data and problem set that we're kind of we're confined in, always specialized model is cheaper and easier, and it can solve the problems. But if there's a lot of uncertainty that is going into the model, and there is some kind of the generalizable capacity, kind of ability that's needed to navigate the kind of the new challenges and solve problems in a way that's usable. But as you can tell, generalized models are more expensive and hard and like messy. So it really depends, like what we're talking about. What is the kind of problem? If we know exactly what problem we would like to solve, then there's a way to come up with the specialized models, and like the models that you're referring to are very much generalized models. Do we need that to solve every single problems at hand? Probably not. But there are things that specialized models cannot deal with. Yes, that's true. So I think there is a room for different type of, and that's why that and in the field of AI there was never one resolution and one answer to this. And like a lot of people, some people are working on generalized models, some people are working on specialized models. And I think that at the end of the day, whether they are all very good research questions and R&D questions that we have to solve, and we are always kind of mesmerized by as humans. But whether they will have a big enough market to sustain in a profitable way is another question, right? If there's a the kind of matter what we can build is one question. Whether and the question of what we build is what we build makes economic sense is another question, right? So I think, will there be a market for every single models that we end up building? Probably not. And which model is going to be picked and left in the coming decades is a kind of is a matter of what decision and by choice that this market is going to make.
Lastly, before I let you go, you've had a really cool career. As you think about your own career journey, how has there been one, I guess, secret to your success?
Oh, that's a really hard question. I don't have any secret. I mean, I think I do it. I was just kind of, I mean, it sounds very much like a cliche, but I just followed passion. I just wanted to do whatever I wanted to do at that moment without really thinking too much about what it's gonna mean to me in like 10, 20 years, because I didn't have the ability to foresee that long. I just kind of followed what I was really excited about. And unfortunately, that led me to very interesting, exciting opportunities.
Then you worked in gaming too, right? Can you believe how complicated video games have gotten? I remember growing up, I would be able to pick up a controller and just play the game. And now I'm just getting lost in these. I don't even play anymore. I mean, they're so complicated.
All right. Yeah. Right. Yeah. Yeah. And I think it's last week. Also like that there is you will be really it will be for another time, but like there is I often said that gaming is always, gaming is, it is true. Like, it's not just me. Like, gaming is at the forefront of adoption of a new technology. Like, because and gaming is such a low risk environment. The worst thing that can happen is a client crash. So, like, a game companies are like can be brave to really incorporate all this kind of new innovative technologies to create the new experience. And that's welcomed by our customers because our customers, gamers, are the early adopters. That's what they expect to the game companies, and the game companies has been always at the forefront of the new technology adoption, including AI, cloud, like streaming and ML and like a lot of those things. That's crazy. That's really fascinating about what's happening today is that after, as you say, like a gaming technology has evolved so much in terms of how we can simulate the world. The gaming engine has been become very sophisticated to the point that people in the research and from the AI research field are saying that, maybe game engine is the operating system for the future, because that's what we see. And there are some people who are even claiming that our brain is a kind of a small little gaming engine. So I think all of those kind of the perspectives and technology evolution is emerging, and then I feel really fortunate sitting at that very intersection of those new amazing technology development.
Well, you have and you are working on some really cool stuff. Song-Yi Yoon, good to see you. Thank you for doing this podcast. I really appreciate it. Looking forward to staying in touch and maybe, I don't know, playing a video game at some point together.
Oh, fantastic.
All right, I'll talk to you soon. We'll talk to you soon.
All right.
That's it for the latest. That's it for the latest episode of Opening Bid Unfiltered. And a quick plug: you just heard us talking about gaming. Be sure to check out Yahoo's gaming site. They are working on some amazing games over there. Go play them. Go to the site. Go and check it out. And then another quick plug: you heard us talking about AI. Go check out Yahoo Scout AI. I have been using this around the clock. It is an amazing new AI function on Yahoo. You gotta check it out. This was all unplanned. I just need to give these shout outs to the Yahoo team. Thanks so much.
We're family owned and operated for over 85 years. But when it comes to where you get your meat and cheese, just call us family. Dietz & Watson. It's a family thing since 1939.
All the good times that come from more me time. All the wonder of what the night could bring. All the energy to turn your world around. It's all here, where simply walking in feels like a win. Get away to it all at Choctaw Casino and Resort Durant.
Welcome to Perk, the intelligent platform for travel, events, and spend.
I strip on sick days.
Breathe Right strips have spring-like bands that open your nose, instantly relieving nasal congestion. So every breath feels...
The power of paralyzed veterans of America can be felt everywhere. For over 80 years, PVA has been a relentless ally for veterans with spinal cord injuries and diseases like MS and ALS, and all people with disabilities, empowering them with the support they need to build the futures they deserve, so they can gain the freedom and independence to thrive. That's the power of PVA.
I'm Jamie, founder of Ring. Our latest invention, Retinal Vision. AI tuning delivers ultimate clarity for unmatched security. Protect your home like I do with Retinal Vision on new 4K cameras and doorbells from Ring. Shop now at ring.com.
Listen, I got this together because I wanted to have this conversation about first experiences in the industry, right? What you learned, what mistakes you made, and how we can educate people today. So I have a question from a listener, Karen from New York, who says to me, if I could go back and give my younger self one trading rule to live by, what would it be and why? So John, why don't you start us off?
Biggest mistake I made investing when I was young was being too heavily weighted in bonds. Believe it or not, 65% of my portfolio was in bonds. That was absolutely stupid.
Well, how old were you when you did that?
How old? I was in about, 25, 26.
And nobody told you otherwise?
Nobody. In fact, the recommendation was to keep a lot of money in bonds. This was going to be for my retirement, okay?
Wow. At age 25.
Right.
Yeah, if you're
that
worried
was
about your
for-
retirement at 25.
Well,
Wait, but what year was that?
Company. It was a
About
company.
what year was that?
That would be about 1980, 1979, 1980,
Wow.
which was, by the way, in 1979, what did Business Week tell us? Equities were dead. Equities,
Really?
yeah, they were in a lot of trouble at that point in time. That's because of persistently high inflation, very high interest rates, and not to be forgotten, shortly thereafter, we had what? Corporate bond yields were at 16 or 17%.
Right. So actually, in retrospect, because Fed funds were 21%, I think, in 1980, 81, right? When inflation had gone through the roof.
Yeah.
And Paul Volcker, Fed chair at the time, jammed rates at 21% to try to kill the economy.
Yeah, and when you think about it, not a lot of investors went into bonds, corporate bonds. One guy did. I think it was the CFO of Chrysler, or if I got his name offhand. Right. He put all their money into these corporate bonds, again, yielding 15, 16%.
Yeah.
He made out like a bandit.
Okay, well,
but
it's hard to argue with that, actually, at 15 or 16% consistently.
Yeah.
I'm going to make you laugh. I'm 65. I don't own one bond in my portfolio yet. I am all stock.
I have never owned a bond.
I am all stocks. I'm probably overweight tech.
And I'm a bond guy.
There you go. Wait a minute. So what's one mistake you made, or that you early on?
Well, he went into bonds.
I went into bonds.
Another one went into.
I went into the bond market.
Right.
I should have gone into the equity market, I think. But look, I mean, you've got to be humble. I think along the way I've traded these markets my entire life. I think when you're right, you feel it. When you're wrong, you've got to feel it. And if you're wrong, you've got to feel it and get out. I mean, you cut your losses, move forward. That is the one thing that I've tried to keep with me my entire career. It's like when you feel you're wrong, don't be like stubborn about it. Just get out, and change kit.
Right, I think that's right. I think that's a problem a lot of people have, is they don't want to admit they're wrong.
They don't want
when they're wrong. They don't want to believe they're wrong.
Right.
And so you end up holding that position.
Well, it's ego comes into play.
100%.
And if ego comes into play, you're going to get burned over time.
Yeah,
for sure.
Yeah, Adam.
I'm sort of tempted to take the other side of this, in that, not that I'm never wrong, I'm wrong plenty of times, but I'm a long-term investor. And for years, I wanted to be a trader. I thought it was really cool to be able to say, yeah, I'm a trader.
Right.
Yeah, phone here and a phone here and back-to-back the guy, buy, sell. But once I realized that that was not an efficient use of my time, because I just wasn't good at that, that I was much better at identifying companies where I thought, by doing fundamental analysis, they could double, triple their cash flow over time, put a forward multiple of earnings on that cash flow, and find companies where we could double, triple, quadruple our money over time. I was much better served by doing that.
Right.
And so if I could tell my younger self something going back, into time, I would say figure out what you're good at, and in part, trust your gut on what you're good at. Look at the numbers, but also listen to your gut. And I used to get so stressed out about trading. And once I became more focused on the long term and cash flow, that whole stress just evaporated. And now when a name goes against me, if I really believe that I have the thesis correct, I'm happy to own something down 30, 35%. I'm okay with it.
Right, but you have to, and I think that's fair. You have to be really comfortable in your thesis to make sure that thesis hasn't changed. The stock's down 30%.
And by the way, thesis can't be a hunch. Thesis has to be, you ran the numbers.
Oh, no, you did the analysis. That's for sure.
Yeah.
I got to tell you, I think if there's one thing that I would tell my younger self today, and I would tell any younger person, is start early. and be consistent. You know, whether it's, even if it's $50 a month, start early and put it away and be consistent and have that long focus. But don't go into bonds. Equities is the place you have to be.
4 or 5%. But great idea.
Well, no, you can go to bonds now, but when they were at zero, it's like don't go to bonds.
No, I hear you. But I think that would be my note to myself would be, you know, as a 25-year-old or a 30-year-old, even if it's $50, $100 a month, whatever it is, just do it and be consistent about it.
Be consistent.
Right?
Month after month, put that money away.
Because consistency, I think, over the long run, it proves to be the winner.
And be well diversified. That's important too. Don't have all your money in one stock. And you know, I've been in that position where gigantic capital gains. I don't want to sell because I don't want to pay the tax on the capital gain. But then maybe I should have in retrospect sold early.
Well, you know, I think it's funny because I don't think it's ever wrong to take a profit. Right? There's some people, to your point, they're in the money, they don't want to sell it. Well, at some point, it makes sense to take the profit on some of it because otherwise...
So I had a mentor many years, and he said to me, whenever you find a stock you want to own, put a target on it.
That's right.
And when it gets to the target, sell a portion. You don't have to sell the whole thing.
That's right.
Sell a quarter, sell the third, sell something. Because the problem is, once you buy, you're only rational once, and it's before you buy the stock. Because once you own it, you fall in love with it. And you say, oh, my God, this company's so great.
That's right.
Maybe, maybe not. So it's a way of honoring discipline. And I've incorporated that in my fund management. And the beauty of selling a little bit when it gets to your target, it did what you expected.
That's right.
And you're freeing up capital to go find the next company.
And you're still in the name.
Yeah.
Because you haven't sold all the whole position.
And discipline is the right word to use.
That's right.
Whether you're short-term, long-term, discipline, it dictates everything in investing.
Right.
You need to be disciplined.
What do you guys think about consensus price targets for stocks? You have any faith in that?
Yeah. That's one of my gut checks when I'm looking. So I'm on Bloomberg, right? And there are a few favorite pages. One of them is ANR, Analyst Research. And as a gut check, I won't look at that. I'll just run the numbers. I'll do my research. It'll take me a few hours, and I'll run the numbers on what I think the company's worth. And then, as a gut check, I look at what the other analysts are saying.
Right, to see where you are, whether you're kind of in
am I crazy bullish or I'm in line or, you know, whatever.
Right. I think that's interesting.
Why? What do you think?
When I do a macro forecast, I cheat too. I look at what the average forecast is, and I put my forecast in and take the midpoint between the two and leave it at that.
Oh, really?
Sometimes you win, you know, but you're not going to make a big mistake relative to the consensus. You want to beat the consensus, but you don't want to lose to the consensus by a wide margin.
That's smart. No, it is smart. It's kind of interesting that because your business is you forecast rates, you forecast credit. Am I right?
And you know, GDP, consumer spending, everything else. So that's been very hard to do, by the way. Forecast consumer spending. This is a great surprise we're living with because we have hardly anything in terms of jobs growth, and yet consumer spending is going ahead at a above average pace. You know, better than 3%. That's a shocker.
Do you think GDP is really above 5%? As the the Atlanta Fed is estimating.
The Atlanta Fed says it's above 5%.
Yeah, okay, but when you take this shrinkage of the trade deficit out and a jump in inventories, it goes down to less than 3%. That's what they're not telling you, and that's another point that I'd like to make is nowadays a lot of analysts and the stuff you're getting on TV and the financial press, they don't look under the hood that much.
They don't look under the hood.
They don't do that with
because it doesn't fit the narrative. If they look under the hood, it doesn't fit the narrative that they want you to know, right?
But that's important to know.
100%, it's important to know.
What's sustainable?
I think that's where it comes down to. You kind of do your own work, right? You got to do your own work. I'm not that necessarily it's on purpose, right? But you have to look under the hood. You have to be somewhat responsible for yourself,
right?
And, of course, the analysts at Yahoo Finance are going to go ahead and look under the hood for you.
Right.
Okay? The story behind the story.
That's right.
That it's really not 5% GDP growth. It's really something under 3.
Right. But even at under 3, for instance, that's still a healthy rate. That's still a healthy rate for the economy to grow.
It's non-inflationary, too, I would add. And that's important.
Whereas a 5 number, if it really were that, is probably inflationary.
Very inflationary.
Yeah.
Well, it would be inflationary if it were consistent.
Yeah.
Right. If it was the first quarter, the second quarter, the third quarter. If it's one quarter, I'm not so sure it's inflationary. But if it was consistent, then I would say yes. Yeah. Right.
It's a lot of import export, right, John?
Yeah, right. Yeah, it's gold and special factors
in the end, right?
Yeah,
it's not domestic consumption.
It's not, it's all, exports boom because of something related to gold. And there was a reduction in imports for the simple fact that early in 2025, all these companies brought ahead their imports in order to avoid tariffs. Okay, right. They imported early, so they didn't have to pay tariffs later, and that will change eventually. Yeah.
By the way, so Delta, this is brilliant. So Delta was taking delivery of one of the Airbus airplanes, but the problem is, if they brought it in as an import, right, it's tariffed at whatever. At the time, it was like 30%. So what they did is they chartered the Airbus, the brand new Airbus, on a special flight from Toulouse, France, to Tokyo, and then Tokyo to San Francisco. By the time it got to San Francisco, it had already done one flight. It was a used aircraft.
It was a used aircraft.
No tariffs.
Oh, wow. Brilliant.
No tariffs.
Is that good?
They are smart.
Let me ask you a question about if you were talking to somebody new, right, that was just getting into it. How important would you tell them it is to pay attention to the macro backdrop versus just someone saying, I like the stock, look at it, everyone's chasing it. They want to jump in just on the chart and not necessarily listening to the macro backdrop?
I think you have to listen.
Yeah, you have to look at the macro. You want to see what's going on. Yeah, if you find out that current dollar consumer spending is growing by 5 or 6%, and you're thinking of going into this consumer products company where their sales are growing by 15 or 20%, maybe that's a warning sign that that type of sales growth is not sustainable. Okay? Right. On the other hand, AI that's a different story. Artificial intelligence, NVIDIA, what their sales numbers look like. That's a dynamic industry. It's just growing, it's evolving.
That's a new dynamic, right? That's really...
Tax Act offers an accuracy guarantee, so you don't have to worry about your taxes. So now, you can worry about the real threat. Those AI robots that look like dogs. Tax Act. Let's get them over with.
All the good times that come from more me time. All the wonder of what the night could bring. All the energy to turn your world around. It's all here, where simply walking in feels like a win. Get away to it all at Choctaw Casino and Resort Durant.
RNs work around the clock. So does WGU. Our one-year RN to BSN program is built for busy nurses. Start on the 1st of any month and get 24/7 access to online coursework, so you can balance life with school. Learn more at wgu.edu.
Tonight.
It is time go.
Think you're being go time, pal.
It's unanimous. Critics and audiences are praising Project Hail Mary as the perfect film.
But I think it's important, though, to talk to somebody who's just starting out about, mistakes you made and lessons learned and how to learn from those mistakes, right? How to, we already said, you have to learn to take profits. You can't necessarily just continue to ride it, right? You have to do your homework, right? You have to be responsible for yourself, and you got to kind of be consistent in your discipline. Remain diversified, right? Make sure you're building it. And you don't necessarily, listen, when you're first starting out and you got $1,000 or $2,000 or $3,000, it's difficult to be diversified. But as it continues to grow, then you can become more diversified. And diversified to you means what else besides just U.S. stocks? International.
International. As I said, you still might want fixed income for defensive purposes. Okay, that has a role to play. If you suddenly have a recession, a deep recession, well, you're going to see that bond yield plummet. Okay, from what is it, 4.25%, probably goes down to 2%, if not lower. It's always possible, and that would offset the losses that you might suffer elsewhere. And I wouldn't necessarily sell everything in the event of a recession, especially if the company itself is still sound.
Right.
So you don't want to have the business cycle dictate whether or not you buy or whether or not you sell a security. It's under pressure.
I'd like to see the 2-year come down to 2.5%, and the 10-year can stay at 3.75.
Yeah.
I mean, I think if you look at even in the global financial crisis, what led us to something that was really, really bad was the long end, right? Long end yields were coming down really, really high, really low, and I know this administration, they want long end yields much lower, but they're higher for a reason. The economy is doing good.
Right. That's right.
And if you've got good policy and inflation is running a little bit higher than expected, long end rates are going to remain where they are right now.
Yeah.
And there's nothing wrong with that.
And you got to look.
I don't think
you got to look at the Treasury bond yield as a regulator. I think this is what you're touching on. It's a regulator of economic activity. The economy is doing better, and if you don't want the economy to overheat, that 10-year yield, Treasury bond yields better go higher in order to prevent the economy from overheating and putting you in a position where you suffer from persistently rapid price inflation. So.
Yeah, absolutely.
And vice versa.
Yeah.
How do you turn, in your mind, how do you turn a bad trade into a good lesson for yourself? Right? Like, how do you take this mistake or this error that you made? Like, how do you turn that into a good lesson for yourself?
Ask yourself, where did I go wrong? What didn't I get?
Right.
Admittedly, sometimes there's nothing to get.
Right.
It was just, something that was unrelated or a macro issue that had nothing to do with the company. That happens. But chances are there's something that you didn't get right, if you're honest with yourself.
Well, if you're honest with yourself, and one of the things, especially when you're young, if you're listening, you're excited about it, and somebody whispers in your ear and says, you got to buy this stock, and you do it without doing your homework, and then it blows up on you, you only have yourself to blame. There's your point.
Well,
you didn't do your homework.
Lesson learned, sizing the position is critical.
That's right.
Size, never be too big in anything. I generally size everything at anywhere from 2 to 4% of capital.
Right.
Right? So let's say I had $100,000.
Doesn't blow you up.
Easy.
Right.
No positions more than $4,000 of capital at cost. You don't want to go out and buy it. That's 4%. The big guys, Apple, Amazon, et cetera, 4%. The little guys no one's ever heard of that may one day triple, quadruple, et cetera, they're 2%. And even if a couple of those blow up, fine.
Okay, and that's exactly the point.
Fine.
2%, because if they
2%.
blow up, they're not going to kill you.
Yeah.
Right.
And I've had a few of those. You
Right.
know?
We've all had a few of those.
Are you telling people to do index funds? That's what it sounds like.
No.
No.
Okay.
Absolutely not.
No.
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 My portfolio has typically 40 names. Right now we're at 44. It's a growth portfolio, the American Ingenuity portfolio. And so if I'm not beating the index consistently, I feel I'm not doing my job. In fact, I interviewed at a place many years ago, Brown Brothers Harriman.
Yeah.
Old conservative Boston bank.
Yeah.
And so these young analysts said, okay, so we have a question for you in the interview. They go, so if you were, describe yourself in terms of a beta. And right, a beta, the market has a beta of 1. So if the stock has a beta of 1.2, it's 20% more volatile than, all right. So, And they thought they were being really cute. Oh, describe yourself in terms of a beta, Mr. Economics major. And I said, oh, well, I'm probably a 1, 2, 1, 3. And you could just see they were shocked. You know, the old Boston from 1, 2, 1, 3. Why are you so volatile? I said, if I can't beat the market, I'm no good.
Right.
I was 22. I did not get the job.
Yeah, but to answer your question, it's interesting because you say index funds. I think when you're starting out, when you don't really know and you're trying to build an initial portfolio, I think you have to start with index or ETF funds. Right? Because, you take $500. What do? You're going to buy a share and a half of Apple? I mean, you can, but you could do it that way.
Yeah.
If you're going to be consistent, if every month or whatever, every couple of months, you're going to put in $200, $300, you're going to buy a share. You could do it that way. Or you could start out by creating an ETF portfolio, which is going to give you broad exposure until such time that it grows enough that you then can start to then diversify more with individual names. That's what I would do if I was starting out.
Or you can buy 10-year yields right now at 4.25.
You'll get 4.25.
And by the way, after inflation, make 1% a year.
Right. Yeah, but when the S&P is giving you 18% or NASDAQ's 24%.
I had to get that in there.
No, you're the bond guy.
I'm the bond guy. Right.
I got to tell you, I'm amazed at such a young age that you said you had 65%.
Right.
To me, that's just amazing.
Well, I was
makes no sense to me.
I was trying to state is, like my parents, they lived through the Great Depression.
Yeah.
And so they're trying to provide me with some guidance. And I said, what do you think, bonds, equities? And my mom goes, bonds. You should have seen what happened to my friends and whatnot during the Great. And that's how they thought.
Yeah.
They didn't get out of that mindset, until years later. That
mindset, that's right. It was, and like you said, into the 70s and early 80s, when the equity market was just horrible. Yeah. 1982, I was on the floor of the New York Stock Exchange because that's where I spent 40 years of my life as an institutional floor broker, which was really one of the most exciting experiences of my life. But one way or the other, I was there. I was 19 years old in the summer of 1982 when Paul Volcker was Fed chair and Ronald Reagan had just become president. We had just done the Reagan tax thing, and they made that surprise announcement on Tuesday, August 17th, where they initiated they gave birth to the greatest bull market that the country and world's ever known. When they came out and they cut interest rates by 10%. 10% was 2 full percentage points because they were 21%.
Yeah.
Right?
Wow.
And so that was the day on that Tuesday, and the market exploded. Right? And the Dow was up 4.5%. The Dow was 792, so 4.5% was 35 points on the Dow.
Yeah,
but it was a percentage move. That was amazing, right?
Yeah.
But it was at that moment that whole argument went out the window because then rates started to come down, and the equity market just took off.
And
for 25 years.
And still, as recently as 1984, I was getting a 10% interest rate on my insured savings deposit. Okay, the savings and loan
1984. Yeah, well, 1984. Right. My first mortgage was 1983. I had a 15.5% mortgage in 1983.
Wow.
Right?
Have you refinanced yet?
People complain about these mortgage rates right now.
Yeah, I know. It's crazy.
And I'm saying,
it's crazy.
You're crying about 6%. Give me a break.
I think portability, I think, is a good concept here. They do it in the UK. They do it in Canada. But at the end of the day, you look at mortgage rates now, like in the context of what we're used to, money is still cheap in general.
I agree with you.
To Adam's point, crybabies.
Yeah.
Right?
I mean, my first mortgage was 7.25%. And I kept calling the bank. I said, if it goes under 6%, and they finally called me, and I got 585, and I thought I was the king, and a hero. And now rates are 605, and people are just pulling their hair out. Oh, this is so high, so expensive.
But I will say, you can't blame them because for 15 years, rates were zero and mortgage rates were 2.5%.
They were abnormally low.
Abnormally low. But this whole generation of people grew up with 2.5% mortgage rates, so 6% looks like usurious.
150%.
Yeah,
and
plus the price of
so it's not necessarily different. It's what they learned, right?
Yeah, it's what they learned.
Right.
Yes.
When I was 19, the rates were 20%. My mortgage was 59%.
Right.
I just accepted that as what it was.
I talked to a lot of these. You're 150% like on it. I mean, I talk to a lot of these younger kids, and they're like, "This is all they know. This is all what they've grown up with." So they think like zero rates are completely normal,
right?
And it's like it's not.
Yeah, but you can't blame them because that's what they learned.
That's what they learned.
And by the way, so is free healthcare, and so is free tuition, and
I think what we're overlooking is the ratio of a price of a home to income. was still significantly lower.
Yes.
When you had a 4.5% mortgage yield versus where you are today.
Right.
Today is crazy.
Right.
The highest ratio since probably 2006, 2007.
Okay, but again, because they kept rates for so long, low for so long, that housing prices just went way out of whack.
Right. And the fiscal stimulus, not only the monetary,
100%.
Together, and that was a big mistake. And I'm always puzzled by the fact that back then, when you had these gargantuan federal budget deficits, when spending is taking off in Washington, at the same time, of course, you had Jerome Powell keeping rates, 0% Fed funds rate, basically, which made absolutely no sense.
Do you remember? He actually said, I'm okay letting the economy run a little hot. It ran hot.
Well, you know what? He made a big mistake, in my view, during the pandemic. He could have just bought treasuries, and he bought mortgages, and he's got all of these mortgages on his balance sheet, and they're not rolling off.
No, well, okay, I hear you.
Right.
I hear you. Janet Yellen could have refinanced long-term debt at 1.5%, which she never did.
Right.
Let's not even go there. Listen, gentlemen, thank you for coming out. I really enjoyed the conversation. The pasta will be right out. That's a wrap for today's Trader Talk. But the conversation continues. Subscribe on Apple Podcasts, Spotify, Amazon Music, or wherever you get your podcasts. You got questions or topics you want covered? Email us at tradertalk@yahooinc.com because we're always listening. Until the next time, stay sharp, stay disciplined, and stay in touch. Take good care.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.
TaxAct doesn't care which tax filing software you've used in the past. Let's get them over with.
All the good times that come from more me time. All the wonder of what the night could bring. All the energy to turn your world around. It's all here, where simply walking in feels like a win. Get away to it all at Choctaw Casino and Resort Durant.
LSU Online is designed to move with you, for you, when and where life happens.
The power of paralyzed veterans of America can be felt everywhere. For over 80 years, PVA has been a relentless ally for veterans with spinal cord injuries and diseases like MS and ALS, and all people with disabilities, empowering them with the support they need to build the futures they deserve, so they can gain the freedom and independence to thrive. That's the power of PVA.
Retinal vision only on Ring. AI tuning for sharper goodbyes, clearer hellos, and safer tomorrows. Protect your home like I do with Retinal Vision on new 4K cameras and doorbells from Ring. Shop now at ring.com.
Tonight,
Words of encouragement.
Can't just say words of encouragement.
Project Hail Mary is the perfect film. Ryan Gosling gives a performance that goes down in history.
Would you just get in here?
This is one for the ages. Project Hail Mary, rated PG-13.
Slow down with vanilla milk chocolate almond. That's Daz.
Getting hard is not the same thing as being turned on. Blood flow handles mechanics, but arousal, that starts in the brain. So Blue Chew is a game changer because it triggers the brain and the body so you actually feel the passion. It's the only arousal boosting 4-in-1 that's worth trying in 2026. So get the only tablet that tackles both. Go to bluechew.com for 10% off and free fast shipping.
Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go until the closing bell here, and stocks off session lows as oil pairs gains. Polymarket bettors, by the way, expect oil prices to remain over $100 a barrel through the end of the month. Joining now to help us make sense of the latest market action are our very own Inez Ferre and Jake Conley. Welcome both. Jake, I'll start with you. Why don't we start, listen, energy prices moving higher. You had this Iranian attack on a key LNG export facility in Qatar. What do we need to know about that?
Yeah, that's right. This war really has evolved from military targeting to energy infrastructure targeting over the last few days. Really, it started with a strike by Israel in the South Pars gas field in Iran. This is part of the largest natural gas field in the world. Iran immediately came back, published a target list, and said, we need to see evacuations. We are going to strike. They have now done so. One of those strikes was on this LNG export terminal in Qatar called the Las Rafin export terminal. It's the largest LNG export terminal in the world, handles about a fifth of all global LNG trade. So this is a major, major hub. You've seen natural gas prices, especially in Europe, already spiking. Today, Qatar Energy, the company that runs that terminal, saying that it suffered, quote, extensive damage and that they might have to declare force majeure on shipments as far as 5 years out from now because the repairs could be 5 years long. So this is a really firm step up in this conflict. I want to call out as well, we keep talking about where are the off-ramps for this? The Strait of Hormuz is blocked off. What other options do these producers have to get oil out of the area? Are there pipelines? There is one very prominent pipeline that runs across Saudi Arabia called the East-West Pipeline. It goes out into the Red Sea, which means you could get oil out into the market. Saudi Aramco just stopped loadings on the Red Sea because of an Iranian attack in the area. So this is just getting more and more widespread and really putting a real threat on the long tail of this, and not only transit, but the actual supply coming out of the ground, going out to the market.
You made a really important point there, Jake. Just this move that we've made here from traffic disruption, right, in the Strait of Hormuz, to now physically attacking energy infrastructure. Walk me through that and the potential market implications of that.
Every strategist I talk to says the market implications of this, it's really, really large because this is a long tail. These kind of repairs on these facilities, these are really hard to repair. Parts are really rare. This is billions of dollars in infrastructure. The tail of this is likely to be not measured in months, but years of repairs now. And all of that is going to slow down production. It's going to slow down capital investment. It's going to slow down flows over time. And that could really keep prices depressed. Goldman out today, this is not their base case. Their base case is lower than this, but they're saying that if the market keeps worrying about these disruptions, if it keeps looking like disruptions are going to be happening for longer, you could see Brent cross its 2008 all-time high of about $147 a barrel. Right now, we're trading at about 110.
And as another headline, I want your take on Trump administration telling oil industry execs today it has now ruled out banning oil exports as a way to bring down energy prices. That's per Politico. What did you make of that?
Yeah, look, virtually everybody across the industry is saying that it would be terrible if they did do some type of export ban. You've got Goldman that's saying that it's not their base case that they would, but if they did, they may do it on refined fuels. I just spoke to a strategist that said that would kill the refineries businesses because their margins are so thin. So I mean, it's obvious that the administration does not want oil prices to be this high. The fact that President Trump yesterday had put out that Truth Social talking about that energy target in Iran, I thought was very interesting because he's basically saying, I don't want this to go into the energy infrastructure. And I mean, that is the red line that we were just talking about.
But then you see him say that if Iran continues, there will be massive U.S. attacks on the South Pars gas field, ratcheting up the tension even higher.
Yeah, that was interesting back and forth on social media. And as switching gears here from oil to gold, which you wrote about today. Gold, you think of course, is sort of the the ultimate safe haven, right?
Yes.
Why is it falling?
Look, that safe haven has lost its luster during this war, because if you take a look at gold prices, they are down about 12% since the war began. You've got headwinds, and that is mainly that you have central banks that are going to hold rates steady and even possibly hike. I mean, you're talking about now there's officials over in Europe that are talking about possible hikes. This is not good for gold, because when you've got higher yields, this makes gold that is non-yield bearing less attractive. And then you've got the dollar that's been moving up. So again, this is also a headwind for gold. Yes, you have investors that are selling their best performing assets, but for the time being, it is not having the reaction that it would when you are in a war. I mean, you think of it as a safe haven. I will say that getting past this, if the dollar goes too high, it starts breaking things. And namely, it also is not good for the bond market as well. So the dollar cannot go too high. At some point, there is going to be some maneuvering to get the dollar lower. And so therefore, that's the case that strategists are making, that longer term, you're going to see this turn around. But for the meantime, yes.
Can I just ask you, only because we talk so much about that's gold, what about silver?
Silver has been much more volatile. Same situation, though, when you talk about the metals in general that are in dollars. But yes, silver is a little bit more of a volatile. It's not the same play. Strategists are not putting this in the same. It's much more speculative, and they're not putting it in the same scenario. You also have a lot of buying that took place with silver in Asia. So we'll have to see how that transpires going forward. But I'm not seeing calls that silver is going to go to its all-time high again anytime soon. I mean, that's more speculative.
And to pick up on Inez's point, you see the same thing on the industrial side of the metals complex. Copper, as of this morning, just gave up its all-time highs for the year. All of the year-to-date gains are now gone as of this morning because copper has fallen so hard. Why is that? Copper typically trades as a proxy for industrial expectations. If you expect growth, copper does well. Right now, what are we seeing? Really lower expectations going forward for growth. People are worrying about industrial growth, industrial demand, so copper is going to suffer. At the same time, as Inez was talking about with the Fed, if the Fed keeps rates higher for longer, if the yields are higher, that's not going to be good for commodities that typically move the other way. So copper's going to suffer there. And if you just keep seeing more and more of this demand destruction, because people don't see the growth, the industrial metals are going to hurt too.
And that's a good point on the industrial side of this. Again, also with silver as well, which is seen as an industrial metal as well. So you are seeing that there are fears of demand destruction that is going to happen.
Finally, Inez, before I let you go, you talked about gold. What about digital gold? Although Rich Bernstein told me on the show, don't call Bitcoin that. Tell me that very clearly. No digital gold. So let's just call it Bitcoin. What's going on with Bitcoin?
I mean, look, Bitcoin was very resilient for a large part of this month. I mean, when you take a look at what's been happening with the war and Bitcoin, but it's below 70,000. You have strategists that are saying that, yes, if the Fed hikes, or excuse me, if the Fed holds steady, maybe if the Fed hikes later, we don't know. But that's certainly in play here as well. I mean, you are looking at the entire macro picture and what is going to happen now that there's a more hawkish feeling, so to speak, on the street.
And let's just point out today, Macquarie strategists came out and doubled down on their call for a potential rate hike from the Fed in the first half of 2027, pointing to some of Powell's more hawkish comments yesterday. If they say if there's going to be a move, that's not just a hold, it's probably going to be a hike at this point in the first half of next year. That's a radical change from what we would have thought 6 months ago. Again, I do not want to be Jay Powell right now.
Jake and Ez, thank you both. Appreciate it. And you can scan the QR code on your screen to go to the Yahoo Finance Prediction Markets Hub powered by Polymarket. Let's focus on the oil markets, as those strikes we just spoke about on energy infrastructure are putting increasing pressure on prices. Joining me now, we've got Jacques Rousseau, Clearview Energy Partners Managing Director of Oil and Gas. Jacques, it is good to see you. So listen, energy prices moving higher. Let's start with that strike by Iran, Jacques, on that key LNG export facility in Qatar. What kind of impact do you think that has, Jacques? How much production can be offline and for how long?
So the facility is very significant. There's three major global LNG producers. There's the United States, there's Australia, and there's Qatar. Qatar was 19% of global trade last year. So when the war began, they just shut the facility down. They said, we don't want to take any risk, and the cargoes couldn't get through the Strait of Hormuz anyway. What happened yesterday was the strike on it, what the company's saying, knocked out 17% of capacity for 3 to 5 years. So pretty significant. The one caveat to think about, though, is that this happened entering spring. Global gas demand is very seasonal. The world uses about 30% more during the winter than the summer months. So that's the one break that's probably prevented gas prices in Europe and Asia from going higher.
You know, Jacques, we talked about this kind of how things seem to have escalated, right? We were talking about blocking supply routes, the Strait of Hormuz. Now we've moved to, really attacking physical energy infrastructure. I'm curious, as an analyst, how do you think through that? How do you think about the potential market implications of that?
Well, the one way to look at it is to look at the futures curve. So if you look at the Brent prices, before the war, Brent was trading in December of this year. So let's just use the end of the year. End of the year, Brent was trading at $70 a barrel. Now it's trading at 85. So people are starting to view this as a longer lasting situation. And it's exactly for the reason that you said, is that we're getting assets that are getting damaged. It's one thing if the strait gets cleared, it'll take, weeks, maybe a month to get flow back to normal. But if assets are damaged, it can take a lot longer.
Another topic I want your take on, Jacques. You did see Trump waive the Jones Act to try to curb oil prices. One, what kind of impact do you see that potentially having? And two, do you think that 60-day waiver could turn into something more permanent?
Well, I guess the way you look at it in the U.S. is that the situation here isn't as dire because the U.S. is a net exporter of petroleum. We still import more oil than we export, but we export a lot of refined products. And so I think with the Jones Act, you're talking about just being able to move things around regionally a little bit more, which will help. But, the big issues that are going on is just the oil price being high, and then that translates into a higher gasoline price in the U.S., which is getting everybody's attention.
Yeah, I want to come back to that, Jacques. But first, just broadly, you're looking at Brent here at 107. Do you look at that level and say that makes sense, Jacques, or no, that is underappreciating risk?
That's a good question. So if we take a look at what the picture was before the war, it was a significant amount of oversupply. We were tallying at about by 4 million barrels per day in the month of March. And now we're looking at a significant amount of undersupply, probably about 5 million barrels per day in the month of March. So you can see this massive swing in oil that's disappearing because it can't get out of the strait. And so to answer your question, I think the longer this goes on, the longer it justifies higher oil prices. It doesn't appear, to me at least, that you're seeing any sort of resolution on either side to slowing down the war. So there's going to have to be some other method. Somebody else will need to step in and try to broker a deal between the U.S. and Iran. Otherwise, this could go on for a long time.
So, Jacques, when your clients ask you, okay, what's base case for oil near to intermediate term, what are you telling them right now?
Well, I think at this point, we thought the oil price was being underappreciated over the past few weeks because this disruption is massive. It's very significant. As your colleague was saying before, there's only a few other ways for Saudi Arabia, United Arab Emirates, and a little bit from Iraq to move oil in a different direction. So there is just a massive amount of oil that's coming off the market. It doesn't take hold right away because countries can fill up their storage with inventories, but we're hitting the point where storage is getting filled, and now you're starting to see more and more oil get shut in because the refined products are getting shut in, so we don't need to produce as much as at the refineries. So what we're going to see is that unless there's some sort of way of de-escalating this war, oil prices are going to stay high for a while.
What does that mean then, Jacques, for product prices? Diesel, jet fuel, what do you see ahead?
Well, diesel definitely very, very strong prices. Jet fuel, you have seen an issue where there's been a big drop in jet fuel consumption in the Middle East because of the fact that no one's really flying. So that has impacted that. But yes, all refined products are going up. And obviously for the U.S., we're hitting into the peak gasoline consumption season. And so that's not going the situation is not going to do any favors for U.S. gasoline prices.
How much, Jacques, does Brent impact the price of what we as Americans pay at the pump?
Well, if you take a look at the market, there's probably about a $10 difference in Brent and WTI. So there is a benefit for U.S. consumers. But Brent prices still impact more of the coastal markets because, especially at the East Coast, they're not using WTI as a price marker because WTI is in the Midwest.
Final question, Jacques. Let's say you could get traffic to return to normal levels of the Strait of Hormuz. Even if you did that, I'm just curious, what is the timeline there, for full resumption? Would it be, in your opinion, days, weeks, months?
It would be weeks to maybe a month, because if you take a look at it now, there's been about, let's just say it goes through the end of March. There'll be a whole month where ships are not leaving the Strait. Well, it takes, 30, 45 days for these ships to get to their destinations in Asia. So, there's a big hole that's in that whole system. So it'll probably take at least a month to get things back to normal.
Jacques, appreciate your time today. Thanks so much.
Thanks. Good to be here.
Coming up, we look at what rising crude oil means for prices at the pump here at home.
The implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy.
Hello, hello, hello. Sitcoms are back. How's that? Funny, complicated, single. Don't tell my husband.
No, she's okay. She's right.
I'm a boss. I'm a shine like boss.
Who doesn't love a little extra life? And a whole lot of cash. Win your share of $2.2 million in cash during the Lucky in Love giveaway. Fridays and Saturdays in February and March at Choctaw Casino and Resort Durant.
Don't rush cherry dark chocolate. Take your sweet time. That's Daz.
I strip on sick days.
Breathe Right strips have spring-like bands that open your nose, instantly relieving nasal congestion. So every breath feels,
The power of paralyzed veterans of America can be felt everywhere. For over 80 years, PVA has been a relentless ally for veterans with spinal cord injuries and diseases like MS and ALS, and all people with disabilities, empowering them with the support they need to build the futures they deserve, so they can gain the freedom and independence to thrive. That's the power of PVA.
I'm Jamie, founder of Ring. Our latest invention, Retinal Vision. AI tuning delivers ultimate clarity for unmatched security. Protect your home like I do with Retinal Vision on new 4K cameras and doorbells from Ring. Shop now at ring.com.
Hey, Ryan Reynolds here for Mint Mobile with a very exciting announcement for parents everywhere. It's called Mint Kids, and it's a plan specifically designed for kids just getting their first phones.
It's a full-size plan for your mini-me.
Nothing like that.
Well, it's unlimited talk and text. 5 gigabytes of data for a perfectly sized plan, so I can't get into too much trouble, right, Big Ryan?
See, this is the kind of stuff that I don't want my kids seeing online.
Upsie?
Yep. No, get out of here.
Upsie?
You stop that.
Upsie?
Terrifying little creature.
Gas prices are moving amid escalation in the Middle East. The national average now sitting just under $3.90 a gallon. Our next guest warning we could be looking at $4 gas soon. Joining me now is Patrick DeHaan, head of petroleum analysis at Gas Buddy. Patrick, always great to see you. So let's just start right there. So you're calling for $4 gas soon. First, define soon, I guess, Patrick. When is that? And then do you see that as, okay, that's a short-term spike, or no, Patrick? That's something more sustained?
Well, you know, a lot of this, by the way, is in mind of what's happening. As long as we don't see any meaningful change in the Strait of Hormuz, I think $4 a gallon is a realistic possibility by next week, by late next week. We'll have to see if there's any de-escalations between now and then. I don't think it'll be permanent. To the president's point, this is temporary, but any increase in the price of oil to this degree is usually temporary. These geopolitical tensions will eventually cool. Oil prices may recede just depending on the degree of de-escalations and what that all looks like. So I hope it's not going to be here for a longer period of time, but it certainly could be.
Patrick, how much could the U.S. cushion through SPR releases or maybe other policies?
Well, you know, there's a lot of small levers the president has. I think the SPR release from the IEA, which is coordinating with the U.S., some 400 million barrels, you know, it sounds significant. But at the end of the day, think of it as a water main, the Strait of Hormuz and the amount of oil flowing through a water main. And the U.S. and the IEA is trying to replace that with a straw. I mean, that's really what we're looking at. The rate of release is rather low. You know, even under the best estimates, we're talking about a release of 2 to 3 million barrels a day, which still pales in comparison to the 20 million barrels a day affected by the Strait of Hormuz. Now, the Saudis are moving some of that via their east-west pipeline to the Red Sea. There are some loadings that are happening there, but a lot of this disruption, you know, until there's some sort of improvement in the Strait of Hormuz, we're going to continue to see oil, gasoline, diesel, and jet fuel prices all reacting to this new reality.
Let's say there was an end to the conflict, Patrick. I don't know, days or weeks. How quickly would that then filter through to prices at the pump?
Well, it'll start rather quickly. Just what like prices went up within 24 to 48 hours of this situation starting. They'll start going down in 24 to 48 hours after we have some clear resolution. Now, it will take a little bit of time. The national average at the fastest pace we've ever seen has declined 2 to 3 cents on average every day over the course of a couple of months. So it may take a couple of months to fully get back down to where we might be. Keep in mind, though, there is seasonality that's also pushing gasoline prices higher, and that'll continue to prevent a full-on drop to pre-war prices.
Trump did waive the Jones Act, Patrick, to curb oil prices. I'm just curious what you made of that decision. What kind of impact do you think that really does ultimately have?
Well, it certainly has greater impacts for areas like California, where refineries have been shutting down. 2 refineries now shut down in the last 6 months in California. That Jones Act waiver will help refineries in the Gulf Coast send gasoline through the Panama Canal over to California. It will also help areas of the Northeast where refining capacity is greatly restrained. Again, it gives Gulf Coast exporters and refineries far more options. The Jones Act, again, for those that may not be aware, requires or did require until it was waived a U.S. crew of shipments from U.S. ports to another U.S. port with U.S. crew and U.S. flagged vessels. So that usually leads to a higher price. Now that that's been waived, products will move more freely and at slightly lower prices. But for motorists waking up, they're not going to notice a plummet in the pump price tomorrow from that at all.
You mentioned California, Patrick, my home state. I'm just curious, what are the sort of key regional differences you see right now across the country in terms of prices at the pump, where they're highest, where they're lowest?
Yeah, you know, for now, the map behind me shows it pretty well. The Gulf Coast and the nation's interior, where gasoline can't easily be exported, are some of the lowest priced areas. The inland areas, the Great Lakes, are a little bit more expensive because some of those states, Michigan, Illinois, and Indiana, have higher gasoline taxes. But where that gasoline cannot be exported in the nation's interior, you're seeing the lowest prices because the coastal regions now are more susceptible to exports. That is, refineries can simply export it to a global market that is in high demand for gasoline, diesel, and jet fuel. And that's exactly what's been happening, which is driving up prices more in those coastal regions.
I'm curious, Patrick, also, what do you think possibly the impact of all this is on American travel? I mean, spring is coming up, spring break front and center for a lot of folks.
Yeah, I mean, it probably will have a more profound impact on air travel, although I looked at some airfares and they still seem reasonable. One of the airfares I booked for Europe later than summer went up 21%. So I think it's going to depend on the length of the journey. Airlines have already been making it very clear that they're passing along these jet fuel price increases. This could keep Americans from some of those longer haul summer trips. But in the short term, I really don't think that we're at the point yet where many Americans are going to start canceling or shortening their plans, especially when you talk about the summer. Americans are certainly going to gripe about it. We're going to grimace and bear it for now as long as prices don't reach record-setting levels.
Finally, Patrick, remind us, because I'm always curious, what are some of the tips and tricks you're using as you look around right now, try to find the best deal at the price of the pump?
Yeah, I think Americans are resigned to not getting any fuel efficiency gains, but that's probably the easiest area for many of us to get more miles per tank. How do you do that? Watch your foot on the pedal, slow down a little bit on the highway, and stop racing from light to light. That's a great start there. Removing excess weight from your vehicle, removing roof racks that you're not using. Driving habits are a big part of it, but then you mentioned how to find the cheaper gas. Of course, apps like Gas Buddy and Google Maps show you lower prices. Pair that with loyalty programs, credit card rebates. Even Gas Buddy has a payments card that saves some money, otherwise cash discounts. There's a lot of different ways to save. If you put them all together, you can save at least $25 or $50 a month.
Patrick, as always, great to see you and have you on the show. Thank you, sir.
Thanks for having me.
Coming up, we dive into what rising oil and gas prices could mean for the health of the U.S. economy.
To a consumer than standing there holding down the gas nozzle and watching the numbers tick on the pump. Every consumer in this country knows exactly what they paid the last time they filled up their tank, what they paid a month ago. And if they were paying $80 a week ago and they're paying $85 this week and they were paying $60 a month ago, they know that I lost $20 of disposable income in filling up this tank of gas.
All the good times that come from more me time. All the wonder of what the night could bring. All the energy to turn your world around. It's all here, where simply walking in feels like a win. Get away to it all at Choctaw Casino and Resort Durant.
Hello, hello, hello. Sitcoms are back. How's that? Funny, complicated, single, don't tell my husband.
No, she's okay. This is right. LSU Online is designed to move with you, for you, when and where life happens.
New Haagen-Dazs Belgian waffle cones. Save the best for last. That's Dazs.
That kind of getting to where you need to be, that's what I hope to build in the community, and it's so needed.
Fed awaits the economic ripple effects of the U.S. war with Iran after it held interest rates steady yesterday. Let's take a pulse check on the U.S. economy and the next steps for the Fed. Luke Tilley joins me now. He is chief economist at Wilmington Trust and a former economic advisor at the Philadelphia Fed. Luke, always great to see you. So the Fed, of course, held steady. They're signaling just one cut in 2026. But you, my friend, you're calling it looks like you're, Luke, for 3. Now, that's interesting. So what are they sort of missing or maybe misreading, you think, Luke, in all that data?
Yeah, I don't know that they're necessarily missing anything, but this does feel extremely familiar. About a year ago, we had some higher inflation readings, and some people started switching over to thinking they would need to hike rates, and it actually happened 2 years ago, too. And we maintained the view that they would end up cutting rates, and it all comes down to the economic data. And for us, it's really how the labor market is doing is going to end up dominating things. So I don't fault anybody, any of the 19 people on the participant list for the FOMC for being a little bit guarded and worrying about inflation. But the critical thing here is that when you have an energy price shock that's coming from the supply side, if you don't have strong enough demand for consumers, then it doesn't play through to core inflation. And Chair Powell said this yesterday. And I think that probably behind the scenes, they're all thinking that this will end up weakening growth more than it will be driving core inflation, though they have to wait and see how it turns out. But ultimately, we know that the labor market is not really creating any jobs right now for the past 6 months, basically about flat. We expect that to continue, and maybe we even worsen a little bit. And we expect the unemployment rate to rise, whereas the median member of the FOMC has the unemployment rate at the same place at the end of this year that it is right now at 4.4%. So fundamentally, it comes down to we're a little bit more pessimistic about the labor market, and we also don't think that the energy price shocks are going to flow through to core inflation.
Yeah, so that's what I was going to ask you, Luke. I guess is what you're another way to put this is energy shocks typically don't drive core inflation higher, and you think the Fed risks here kind of overreacting to headline inflation?
Well, I think they're just being cautious. And yeah, energy price shocks can flow through to core inflation. But the critical distinction is an energy price shock really just being driven by a supply side, which is exactly what's happening right now, undeniably, or is it accompanied by strong demand, strong spending, strong consumers? Because when you have strong demand, strong consumers, just like you did in 2004, 5, 6, crude prices were rising then too, but you had a strong consumer, and that drives inflation higher, and that drives the need to cool the economy off. But this is going to end up playing out very similarly, we think, to tariffs a year ago. A year ago, everybody was worried that tariffs were going to drive inflation higher, and we took the position at the time that said, consumers are not in good enough shape to handle these tariff-based increases. They're just going to cut back on their services spending, and services inflation is going to slow down. That's exactly what ended up happening last year, and you saw that reversal through the summer and into the fall by the Fed, and this is essentially the same thing. I mean, for most consumers, you can't avoid gasoline price increases. It functions like a tax, very similar to a tariff, and because we have, kind of normal wage growth and essentially no job growth, this is going to end up weakening the consumer. So I think that they'll pull back on services, they'll pull back on everything other than gasoline, and you end up getting weaker inflation. And that's the critical thing here, and that's what we expect to play out over the rest of this year.
On that labor market, Luke, when Powell spoke about it, it sounded like broadly he was kind of characterizing it as generally stable. You're seeing underlying weakness, though. What are the specific cracks, Luke, you see that we need to be paying attention to?
Yeah, the biggest thing here is that when you take the private sector, so get rid of the government, because the government doesn't react to economic cycles, right? And then so just take all the private sectors. And then if you remove the healthcare sector, the healthcare sector always adds jobs. It doesn't matter what is going on, maybe like 1 month during COVID. But even when Lehman failed and you had a financial crisis, the healthcare sector was adding jobs. It is a secular grower. It does not respond to economic fluctuations. When you take all the other sectors, since the Rose Garden tariff announcements last year in April, all the other private sectors have cut jobs by more than 300,000 in total since April of last year. This is an economy with a lot of uncertainty, a lot of changes, and employers are simply cutting jobs right now. Yes, there is some drag from the fact that we have lower labor force growth, but there's a lot of job cutting going on. There's a lot of people who are looking for a job and they give up. Yes, the continuing claims this morning continue to be low, as we saw this morning, but there's a really high rate of people who are exhausting their benefits and just rolling off. So they're no longer in the continuing claims. And then fundamentally, Chair Powell said yesterday, the February unemployment rate, 4.4%. It really hasn't moved since September of last year. Technically, that's correct. But when I look at it, I see an upward trend. It's been moving up since the end of 2022, basically. And when you've got such low job creation and so many people out there looking for it, combined with higher gas prices, we're expecting to see the unemployment rate creep up. We have it forecasted to go up to 4.8 to 5%, whereas the Fed is forecasting, like I said, at the end of this year, the median forecaster expects it to be unchanged from its November level. And I think they'll be wrong before April or May on that. And they'll start changing their tune when the labor force numbers come in weaker.
On the consumer, Luke, I don't know if you saw this. CBS had a story out. If you didn't see it, I'll read it to you. They were sort of talking about surging gas prices, Luke, and how that could basically really wipe out these bigger tax refunds. And they cited economists at Stanford. I'll read you the numbers. They say the average U.S. household is now going to spend an additional $740 on gas this year. And if that is true, they say, that then basically gobbles up nearly all the additional money people are slated to collect in tax refunds. I was just curious, through the lens of an economist, what do you make of that?
Yeah, it acts like a tax. Most people cannot go out and buy a more efficient car when oil prices spike. So they basically have to deal with it. You can change your transportation habits a little bit, but it takes away from your ability to spend on other things. And that report is doing it sort of on an individual household basis, which is definitely one way to look at it. Another way to look at it is the macro. So if you think about the new tax cuts in the One Big Beautiful Bill Act, so overtime and tips, expanded child tax credit, all of those things, the estimates of how much more you're going to get in tax refunds this year range anywhere from 125, let's say 150 billion. Consumers spent about $450 billion on gasoline and diesel last year. So if you get a 30% increase in the total gasoline and diesel bill for this year, that completely wipes out the benefits that you get from those tax cuts. And this is not, a judgmental thing. We're not saying things are good, bad, or indifferent, or the tax cuts should have been higher. Just in a purely mathematical sense, a 30% increase in gas prices, if it were to persist for the year, would wipe out the highest estimates of the benefits from the marginal tax cuts, and then you no longer get that boost.
Luke, just a final thought. I'm just curious, how tough is it for you right now to kind of model a forecast? Because in an environment, Luke, listen, there's always questions, but right now it just feels so cloudy. I mean, we don't know when this war ends. We don't know when this oil disruption ends. I mean, there were some well-known economists, Luke, this week who were telling folks, listen, just don't put any weight on this dot plot this week. And I'm wondering how you think through that.
Yeah, I think I think there was a Federal Reserve chair who was saying, don't put a whole lot of weight on the dot plot. And I sort of agree with those economists. And Chair Powell said in the past, these things become stale with every passing day. And he was pretty explicit about that yesterday. He said, we have to write down a number. We don't want to skip forecasts like the one time we did it during COVID. And I think that they put those forecasts down with a lot of humility, saying, we don't know how this is going to turn out. The data and the prices can change, as they did today relative to yesterday in terms of gas prices. So I don't put a whole lot of stock in the dot plot. And, I'm not indicting anybody on the FOMC there. I'm going along with what they said because it's just very challenging. And we here at Wilmington Trust just have a different view on where the labor market is headed. And if our expectation turns out right, then the Fed is going to be cutting rates later this year, just like they did last year after a scare in the spring, and just like they did in 2024 after a scare in the spring. And that's what is going to end up dominating it is the labor market.
Luke, as always, great to have you on the show. Thank you.
Thank you.
Markets have taken a roller coaster ride just today alone as investors weigh the effects of the Iran war. Edward Jones CEO Penny Pennington gave a little advice for those navigating all this uncertainty.
Many of those playbooks are similar to what they have always been, which is understand your risk tolerance, your ability to deal with these kinds of up and downs and curveballs, because these will always happen. Understand your time horizon. How long do you have? Notwithstanding that we hope that this doesn't go on for a long time, we also know that there's always going to be uncertainty to deal with. So what is your time horizon? And then what are your goals? What are your hopes and dreams? It's important then to establish an investment portfolio that matches those things and that is well diversified. And right now, notwithstanding oil prices and prices that are going up, we also have some tremendous values in the market, ways for clients to take advantage of what's happening right now. But as we say, our financial advisors, 20,000 financial advisors, it's our job to take that anxiety off your shoulders, put it on ours, use those sturdy rules of the road, help you rebalance your portfolio, and stay focused on your world.
Where are you seeing those areas of opportunity now that the markets, I mean, look, the markets are not that far removed from their highs, but if you dig beneath the surface, there's a lot of sectors in the market that are in correction territory, and certainly in some cases bear market. I mean, look at software stocks.
Yeah. The lesson there is not to get wed to any one sector or to assume that any set of stocks is always going to go up. Trees don't grow to the sky. And so a well-diversified portfolio that takes advantage of those counter-cyclical movements is very important. Value stocks right now, the technology stocks had some tremendous days in the sun, and I think will continue to. But the promise of AI and generative AI, and we believe that there's a lot of promise there, the productivity promise there, might begin to transfer from the tech biggies to the companies who are going to utilize those tools to drive greater value and efficiency for their customers and their clients.
Hello, hello, hello. Sitcoms are back. How's that? Funny, complicated, single. Don't tell my husband.
No, she's okay. She's right.
I'm a boss. I'm a shine like boss.
All the good times that come from more me time. All the wonder of what the night could bring. All the energy to turn your world around. It's all here, where simply walking in feels like a win. Get away to it all at Choctaw Casino and Resort Durant.
Did you hear about Shield, that test for colon cancer? No, what? It's just a blood test. No. Exactly.
Shield is for people 45 plus at average risk, not high risk for colon cancer. Ask your doctor about FDA-approved Shield.
Tonight,
it is time go.
Think you mean go time, pal?
it's unanimous. Critics and audiences are praising Project Hail Mary as the perfect film. This is one for the ages.
Amaze, amaze, amaze.
Project Hail Mary, rated PG-13.
I'm Jamie, founder of Ring. Our latest invention, Retinal Vision. AI tuning delivers ultimate clarity for unmatched security. Protect your home like I do with Retinal Vision on new 4K cameras and doorbells from Ring. Shop now at ring.com.
New salted caramel macadamia bar. That's DAS.
At this point, you're probably not avoiding therapy because of stigma. You're probably avoiding therapy because you've become very good at coping. So good that you stop noticing how heavy everything feels. As a therapist who goes to therapy herself, it's important to remember that your mind and body hold on to every stressor you don't have time to process. That stress shows up as exhaustion, irritability, shutdown, or feeling overloaded in a way you just can't explain. Therapy can help you start releasing it. Now, one barrier for many people is knowing how to choose the right therapist. BetterHelp removes that barrier. You answer a short questionnaire about your goals, preferences, and needs. BetterHelp reviews your responses and matches you with a therapist that fits what you're looking for. You can meet over video, phone, or live chat, so the format fits your life. Many clients report meaningful symptom improvement within 12 weeks of consistent sessions. If you want to walk into 2026 with less mental weight and more clarity, therapy with BetterHelp can be your starting point.
500's financial sector is on track here for a disappointing first quarter of 2026. Yahoo Finance's Inez Ferre joins us here with a closer look. Inez, I want to go through the story you filed today. It's a good piece. It's on private credit. And starting here, there's talk here in your piece of yellow warning lights in private credit. Start there. What exactly is flashing?
Right, and that's what one strategist had told Yahoo Finance recently. It's the sort of yellow warning light. It's not a red warning light, but if you take a look at what Wall Street is saying, they're basically saying that, okay, there are these headlines that have worried investors. You are seeing redemption caps with some of these funds. And so they're saying it is a crack in the private credit industry that you want to be aware of, but this is not a systemic risk. What they're basically saying is that this is not a contagion that is going to impact the rest of the economy. You are though seeing these prestigious firms that have been taking measures to sort of cap redemptions for some of these funds. I mean, you're talking about BlackRock, Morgan Stanley, Blackstone, and so the feeling is that this is going to be a concern, especially as you have a maturity of debt that's coming up. So this maturity wall that is of debt that was taken out about 5 years ago or 6 years ago, while you saw that interest rates were very low. And so that debt is now coming due. And so there's a feeling that there are going to be some defaults. And you've got Morgan Stanley that basically says that overall they're expecting direct lending default rates to reach 8%, approaching COVID peak levels. That's because you have some of this debt that is maturing, 11% of software loans maturing by the end of the year, and another 20% maturing in 2028.
Those redemption caps you mentioned a second ago, BlackRock, Blackstone on private debt funds, how unusual is that?
Look, I mean, you were talking about years where you saw these inflows going into these funds, and now you are seeing that you're looking at redemption caps that are redemptions of 8 to 9%. That's higher than expected, and so there is a feeling that okay, we are starting. A lot of it also has to do with the headlines that are feeding on itself on themselves, right? You see that this is happening, and so therefore it's almost like a domino effect. You have fear, and so therefore you have investors that are looking to redeem, and so now these funds are saying, well, hold on, we can't give it all at once, and so you don't want to run on banks, so to speak. But a lot of this has to do with software and what's been happening in the software space.
That's an interesting, important thread, AI and these AI disruption fears and how they're creeping into credit risk. Walk us through that.
Yeah, and that's because a lot of these private credit is exposed to the software sector. In fact, it's estimated around 20% has gone to software. So if you now have these concerns about what's going on in the software space as a whole with AI, you have concerns of business models that are going to be disrupted. You have concerns on the way the profits that are going to be shrunk. You have concerns about even the way that they charge on per seat. Now, how are they going to charge now if you have less people that are working? So it's an entire, we've seen what's happened in the software space. We did see a little bit of a bounce, though, when you talk about software over the last month. I mean, we have seen some rotation going into that because Wall Street is saying it's a little bit overdone. It's a little bit overblown. Okay, yes, there's going to be some disruption, obviously, in the software space. But this is going to take time, and they will adapt, and they will pivot. That you will see pivots within the software industry that is not going to be as bad as feared. At least that's the sentiment on the street right now.
And I guess bottom line, what we're talking about here, Inez, do you look at it and say, okay, this seems still kind of niche and contained, or no, this could sort of spill into something broader?
It seems to be niche and contained to the private sector space in general. Even when you look at what some strategists, some of these firms have been saying, is that when you're looking at the private credit space and how much they lend to companies overall, you're still seeing that it's not as large as other forms of lending. So it's seems to be contained, but it is something that's given the market jitters. I mean, we're talking about it now, but we've really been talking about the war for and energy prices a lot more over the last couple of weeks. So it is something to be aware of, and especially as you see this debt that's maturing.
All right, Inez, thank you. Appreciate it. Shifting gears to the auto space, Uber and Rivian adding fuel to the increasingly competitive robo-taxi space in Yahoo Finance's Praz Subramanian joining us. All right, Praz, let's start on that story. This knows about Uber, this deal, I'm just curious how it's structured, actually, because this $1.25 billion, I mean, how much is that as sort of real money versus, hitting certain milestones?
Yeah, it's a lot of milestone stuff here. So, upfront, $300 million upfront contingent on regulatory approval for about 10,000 of these robo-taxis, right? And the balance over the next few years for 40,000 more, and then you unlock that $1.25 billion, which is, this is a significant investment. We saw the stock pop a lot earlier today, sort of tailed off a bit as trading began. But yeah, this is a big deal for Rivian. It's sort of a bet on the new R2, and for Uber, it's sort of the next step in their sort of their Uber or robo-taxi plans. So
if you look at Uber, you got deals with Rivian, Waymo, NVIDIA, Lucid, right? What's the broader strategy here?
It's like they're spreading their bets across both the providers of the cars plus also technology, right? So in the case of the vehicles, it's Lucid, it's Uber, other manufacturers, right, that they're using for EVs, that they're using for their robotaxi fleets of their own, but also for their partners. They have partners that manage fleets, and they're saying, hey, use our platform, you manage the cars, right? But I'm talking about the technology or software space. You have NVIDIA with both hardware and the car plus software. You have also a company called Neuro, which they're working with Lucid, right? So you have a bunch of different, and also Waymo. I forgot about Waymo. Like Waymo, you're allowed to basically book Waymo on Uber's app in certain cities, and they want to expand that too. So they're really spreading their bets across a number of providers. Maybe it's a way to sort of see who wins out, who has a better technology, how do we spread our money across that, and not ourselves being Uber betting on one particular thing.
We talked about, by the way, what this means for Uber. What was your take on what it means for Rivian? Because, that seems like a big order.
It's huge. And you have a company like Rivian that's still chasing profitability, right? And they're scaling up the production of a brand new car that they think will be a volume seller for them. And this is a big shot in the arm in terms of capital to get that to work, get a little more runway to get the car up to volume, because they believe that once you get the car up to high volumes, then it'll be profitable for them, right? Because it takes time to kind of defray this capital costs you put up, right? It's age-old story manufacturing. But with Uber's sort of partners, Rivian's partners with, not just Uber here, but also Volkswagen, huge investment in the company, right? That also took them sort of past a sort of a runway there. So it's big for them in terms of just being able to defray those costs of development for these cars and have Uber be a huge buyer of a number of these vehicles.
By the way, another story you wrote about today, BMW officially unveiling its new i3 EV. What did you make of that, and how did you see it sort of compare and contrast with the Tesla Model 3 range, charging, performance?
So BMW's been talking about this. Their new like basically their second gen EVs are going to be based on a thing called the Neue Class platform. It's a brand new platform, supposed to be more efficient, better batteries, better driving apparently. So this car has been teased for a long time. We finally see it in sort of production form. And basically, we have a little chart here, compares very favorably to the Tesla Model 3, which is sort of the standard bearer for EV sedans. See that price, BMW i3 is going to be probably around $55,000. Not cheap, but a BMW 3 Series around that kind of money, right? So, but compared to the Tesla Model 3 Performance and Model 3 Premium, both of the all-wheel drive versions, because the i3 is all-wheel drive, you see that pricing not too bad, but you get a lot more range, 440 miles, which is a big deal for people from a psychological standpoint. Hey, I can drive this car all week and not have to charge it. I'm not afraid of that. So that's a kind of big thing. And I think the car looks, it looks good. It's not super aggressive. They almost made it a bit conservative. But the inside, I think, compared to Tesla, the inside cabin is much nicer. So you have a bit more luxury there, a bit more premium feel there. I think that's kind of a big rival or at least competitor for the Model 3.
All right, Bryce, thank you, buddy. Come up, we've got you covered with all the action following the closing bell.
home updates to major repairs. Bauer, heavy duty guaranteed.
All the good times that come from more me time. All the wonder of what the night could bring. All the energy to turn your world around. It's all here, where simply walking in feels like a win. Get away to it all at Choctaw Casino and Resort Durant.
Slow down with vanilla milk chocolate almond. That's Daz.
The Bush Guide, cold and smooth survival skills. If red touches yellow, it'll kill a fellow. But if blue touches white, it's Bush. Light. Head for the mountains.
We'll come back later. Stocks ending the day lower here, but paring back some of their earlier losses after Israel's Prime Minister Benjamin Netanyahu said it won't strike Iran's gas fields as the country can no longer enrich uranium. Netanyahu also saying Israel will work with the U.S. to open up the Strait of Hormuz. Our very own Jared Blickery with us live from New York Stock Exchange with what he's hearing about this on the floor. Jared.
Well, thank you, Josh. Look, we got a mixed day here. Looks like things could have been worse, and I think that's kind of the attitude I've heard from a lot of people. But that Federal Reserve meeting yesterday is probably more important and a little bit more hawkish than a lot of people are giving credit to. And you can really see that in the gold market. Gold just it cracked 5,000 the other day, and it just had one of its biggest sell-offs since the Goldmageddon at the end of January when we had silver down some tremendous percent. My point is that these things are working themselves throughout the market, and it looks like tighter financial conditions. You can also see this in the U.S. dollar index, which is pushed above 100, and it's been hovering around there. So a stronger dollar is not necessarily risk on. We've seen it hurt countries, stock markets all around the world, but it also weighs on international stocks, on commodities. We've seen that in crypto. And in general, we've seen markets kind of sell off in the beginning part of the day or open lower, and then sometimes claw back gains. So it hasn't felt that bad, but we keep losing these levels. The S&P 500 opened to, what was it, fresh 6 9-month highs this morning, and if not those, then flirting with 9-month lows, excuse me, not highs. So this market keeps taking out levels, and you're wondering, when does it stop? So we haven't seen any panic selling by any extent, but we haven't seen the most bullish price action either. If you take a look at the sectors that have been leading in March, it's only one that's green, and that is the energy sector, and that's because crude oil is now triple digits, everything else in the red. And the tech trade itself has been broken for a number of months. We saw some weakness off of Micron, and really that did not translate into a broader chip sell-off that you might have thought. So that actually wasn't that bad. But software has been the real boogeyman in the tech trade. That peaked last September, October, and it's fought at various times to come back. But those have been nothing more than short-lived, short-covering bounces. So until we see some real leadership assert, and I'd like to see it in maybe something bigger like the industrials, or tech would be ideal, energy alone cannot carry the trade. So I think this hawkish Fed reaction, kind of postponing any hopes of Fed interest rate cuts, that is a big deal, and it's probably not fully priced into the market right now.
All right, thank you, Jared. More on the latest market action is Cole Smead, the CEO of Smead Capital Management. Here, you say investors might be underestimating this sector. How come? Walk me through that.